All right, let's get this going here.
What up?
Yo, what up, Scott?
You're cool.
You're coming in like all crazy robotic. You got a good connection, Scott?
All right, can you hear me?
Yeah, there we go.
Woot woot. All right, yeah, I had to download the app.
Again?
Yeah, I was using the browser. Mm-hmm.
All right, well, no worries. As long as it's all good now, that's what matters. So that's good. All right.
Yeah,
So,
music's at a good volume too.
all right, yeah, it should be pretty low. I think I lowered it a pretty good amount. I could barely hear it, so I know it's got to be pretty low. If it's too loud, then just let me know. You can always right click Metalbot and then lower that yourself personally. And then on the stream itself, that's got to be controlled over here. Unfortunately, there's no way around that. Not yet. Not these days. Not these days. All right. So Scout was here for a second. He had a bad connection, so he dropped out. But he should be coming back up. But he'll be fine. He'll be fine. So let's get right into it. Price action. Now the good thing about price action is we've already gone over horizontals, support resistance, and trend lines. And those are sort of the fundamentals of price action. Price action is also called naked trading, where you're only looking at the price, right? You're looking at candles and whatever the chart shows you, as far as what it looks like, what kind of patterns it's making, what type of trend is it in. Is it consolidation? Is it an uptrend? Is it a downtrend? What time frame are you looking at? Price action doesn't even involve volume, right? Volume is volume-based trading, and that's what we'll cover more than likely next week. But price action, simply put, is what is happening to the price on the chart at the time in the essence of what time frame are you looking at, because things will change as you zoom in. So if you look at a weekly chart as opposed to a 15-minute chart, you might be seeing a downtrend, but on a weekly chart you might be showing a big uptrend. So you could just be zoomed in on a pullback. So that being said, what most price action traders will use is visually what's in front of them, and then they take into consideration no indicators. So you won't have any lagging indicators. You won't have RSIs. You won't have MACDs. You won't have anything that'll give you any type of lagging indication, EMAs, SMAs, although some will use maybe an MA just as a moving average for dynamic support resistance. But you will look at trends, and you'll look at patterns. More specifically, you'll be looking at reversal candlestick patterns. Those are some of the most important. So you'll be looking at shooting stars, you'll be looking at hammers, you'll be looking at bullish and bearish engulfing candles. Those are best friends to a price action trader, because a price action trader is sort of hedging on when the next reversal is going to be, and are you going to stay in trend, or are you looking at a pullback? So what I did was I put something relatively familiar, ETH USD. I went with Kraken because I needed a clean chart with nothing on it.
Okay.
So I don't really look at the Kraken chart all that often. So this was a chart I knew I could come on and just rip apart and not have to worry about anything. But what we're gonna do is we'll start on the view of what we're looking at right now, and this is going back to trends when we're talking about trends. If we're looking at the overall global picture here, right, we would be looking at what would be considered an uptrend. The issue would be this low right here. And let me see, I just got some weird echo, so let me get rid of that. Okay, so where this low ends up over here is where you have to question on
Count, mute your mic.
What's that?
It was Count. I told him to mute his mic.
Oh, okay. All right, perfect. So in order for you to have an uptrend, right, you have to have a few very important things, right? For one, you have to have price action going up. All right, you can have a pullback. This makes sense, right? Because that's going to be a higher low, and then you're going to have prices going to move up again, and this is now going to be a higher high, and then you can have it come back down again, and this is going to be now a higher low, and so on and so forth, and that just continues on and on and on. And all these pullbacks are measured with Fibonacci's, and you can bring those down and find out, was it a 236, a 382, a 5, a 618, whatever the case may be. As long as you have a higher high and a higher low, then you're in an uptrend. Now, quite the opposite, obviously, is if you're in a downtrend and the price comes down, it comes back up, it goes back down, it comes back up a little, and it goes back down. And we're all very familiar with this, right? So in a downtrend, you have to have a lower low, right, and a higher low. Or, I'm sorry, a lower low and a lower high. And this will give you the overall pattern of a downtrend. But what happens when price comes down like a pullback, but ends up getting lower than, right, your last level, your last high, and is not able to come up over that. All right, so now you're over here, and then you come back down. So this is what you're looking at. And this is now a lower high. That's your first indication that you have some type of trend reversal. So you have a higher high, a higher high, a higher high, a lower high. Once you have a lower high, this is considered a fail, right? You fail to make a new high. And when you fail to make a new high, they call that a failure swing. So because this was a failed high, now you're looking back at old levels and you want to see where that last level reached and why did you find support at this zone. Now I just drew it this way just because it is what it is, but this would end up being a support level, and what price action traders are looking for is this break. And at that point, then they'd be looking to go short. And when they go short, now they're looking for a continuation of short trading. So in other words, you're gonna have lower highs and you're gonna have lower lows, and you're gonna continue that trend until yet again, now you don't make the next lower low. So price comes up and then you're over here. And then you have to start saying to yourself, okay, well, we didn't make this low, right? This should have been down here for continuation downtrend. It's not. So price has reversed for one reason or another, and now it's up to the trader to decide, is this just an aggressive pullback, something much further than a 618? Is this a full 100% retracement, or right, is this new trend? And are we looking at new trend? And we're going to talk about those levels and how they are determined by price action traders. Okay, so having the chart in front of us, we're just going to use the chart as an example instead of drawing everything out, because there'll be plenty of examples on here that'll let us know, what we're looking at. So when you're doing price action trading, you need to know trend, and you need to know what trend you're currently in, and you need to know that on a large scale. So because on the daily, then I'm looking at a daily chart, and that means I'm looking at macro trends on a daily time frame. If we were to put this in a 4-hour chart, that means I'm basically a 4-hour swing trader. So I'm looking at plays that'll happen intraday, or could be up to a 24-hour trade, maybe a few periods of 4-hour trades, up to let's say a week to 2 weeks. You could be in that same trade if it's all going in the right trend, in the right direction. So you're looking at large moves. This intra stuff in between here, we're going to talk about that, but those are considered micro trends, right? We're not overly worried about those right now. Right now, on a big scale, you're looking at big moves. So you're looking at a low, an obvious low, a high, okay? So these two right here, this will tell you, all right, well, I got a higher high and I got a low. Now, because there's no low in the future over here, you have to go with the next low, even though this is not considered micro, but it is on the ballpark of a micro trend. So when this low happened here and price reversed up, then you can say, okay, I got another higher high. Now you have this low here, but price continued on, and you got this low. Now this low is the one you're looking at, because this low is what changes things, right? This low, although it's a low and it's lower than this high, the issue was that you already had 1-2 lows pop in. Now this one's lower. So this is what price action traders are looking for. And at that point, they're going to start drawing trends and lines. And you're going to start seeing where these things are going to break. And then you'll start getting a picture of how a price action trader thinks. All right, so first, let's draw a couple major lines here. Let's draw this line for one. All right, this is what starts your trading out. We're going to skip over a lot of this noise here, and we're going to say, all right, we got ourselves a high. Come on now. Come on, marker. There you go. All right, so we paint ourselves a high here. We got ourselves a low. Come on, marker. Do your thing. There you go. It might be a little sloppy, but you'll get the overall idea in a second. This is how macro you'll end up being when you look at these trends, because you're looking at large trends that are giving you overall direction of an entire market. Okay. And we're going to keep this guy here. That was a pivotal point. I'm going to keep this guy here. And then we're going to draw it down. Okay. So, if you were looking at this chart, would you agree that you had an uptrend up until this point? And at which case down here, this was your first indication that you might have a reversal, being that you have a new high that is a low. It's lower than this high here. Are you with me on that, Unity? Yeah? I don't know if I lost you or not. You there? Well, I'm going to hope you're with me. If you're not, then stop me.
No, I'm here. I'm here. The Twitch stream is like 30 seconds behind you, so I have to like mute you here and like follow there. Otherwise, it's like way out of.
Oh, gotcha. Okay. Yeah. No problem. No problem.
Okay, so you asked me would I agree. We had an uptrend up till that day, and then
Yeah, and then what happened was we made our first high that was a lower high, a major swing high that was not higher than our last high, our previous high. And because of that, that is now what triggers in the mind of a price action trader, all right, possible reversal. This is where they're starting to look and say, okay, my uptrend that I had for such a long time is now being threatened. Even these smaller highs were still higher than the previous high. And this one here is very clear that market was down, price came up, and it did not pass this level here. So this was a failure. Right, so that's a swing failure, right? Failure to make a new high. Now, looking at the chart, and we say, okay, as a price action trader, we know we were in an uptrend, and now we have to start looking for what could be a downtrend. So, okay, now this is when we start bringing out our horizontal support resistance that we learned previously. And so levels that make sense to price action traders are historical levels of swing highs and swing lows that now are going to become support or resistance. So they're going to look over here and they're going to say, okay, I had a level over here that was a high, very close to this high, almost a double top. So I'm going to say that this zone here is an area of interest. And so on the way down, they're going to say price came up, price found support on my last swing high. So right here, if you break that zone, then that is where you're going short. And that is how a price action trader thinks. Right there. If this level gets broken, that's confirmation that we've lost our high. That's confirmation that we lost our uptrend. And now I'm starting to look in downtrend. So now they're selling short. Okay? And again, going back to horizontal support resistance that we spoke about last week or the week prior, these levels all make sense. Right? With this failure to make a new high, the pullback was right on that same zone. The same price zone. And within that same zone, plus or minus a few dollars, that's where everybody's looking. When this pullback came down and it found support and price reversed, then everyone's looking to say, okay, well, if it doesn't find support again, and if it breaks this next time, I'm going short. I'm going to go short maybe just a level or two underneath it, and I'll put my stop maybe the candle height above it. And then this will at least give them an indication of overall trend reversal, and that is what price action is looking for. They're looking for trend reversals and trend continuation, because there's three ways that you can have a trend in any market. It's either going to be an uptrend, it's going to be a downtrend, or it's going to be sideways. Sideways trend is accumulation, consolidation, could just be range bound. There's a lot of different ways it could be sideways, but the definition of an uptrend is you have higher highs and higher lows. Definition of a downtrend is you got lower lows and lower highs. And if you're not meeting that criteria, then you're in the overall definition of sideways. And that's how trend is gonna play into price action trading. So we can get rid of, we can literally get rid of all this stuff on here, because in price action trading, you're probably not going to draw your trend out, although you can. There's absolutely nothing wrong with that. But more often than not, you're gonna leave it somewhat naked, because you will have lines on here, and those will be trend lines or support resistant lines. You could be drawing patterns such as a channel, a rising wedge, a falling wedge. All of those are important, and they're all important for specific reasons, because they are part of price action trading, and you're looking for patterns or major reversal patterns, such as head and shoulders, inverse head and shoulders, double tops, double bottoms. Those are what price action traders look for. They look for indication of where trend might reverse, and then they set their trades up accordingly with low risk on the opposite side. And if it doesn't go that way, then they continue to watch the trade. Now, I mentioned that we had the large trend, right? And in between every trend, you have micro trends or local trends. And that is all of these little ups and downs and peaks, and that you see inside of this choppiness that is getting you to your next higher high. And you can always tell a higher high and you can just tell a high and a low, because they're out in the middle of space, right? There's generally, there's nothing really around them. Where all this stuff, this intra stuff, they're just they're cluttered in there with all the other trading. And you got tons of little micro trading going on in between here. But a price action trader isn't necessarily looking at all these micro trades. He's taking his trade down here, confirmation or reversal, let's just say, and he's looking at these levels. And if it were to come down and it fails to make, a higher low, then okay, now he's interested, and now he's thinking about maybe getting out of this trade. Like here, where this ended up being a bottom and a bottom and a bottom, right? For price action traders, they would be getting out of that trade, right? Regardless, and they'd have to sit and wait and see, okay, what's the next big level here? So, all right, well, we failed to make another new high. So at this point, they're saying, all right, well, I need to decide, when is this thing going to break, and is it going to break up or is it going to break down? So I'm going to come back to this in a few minutes when we get a little bit deeper into micro trends, but I want to also focus on a few patterns that'll at least be easy to see on this larger scale time frame. So in any trend, you're going to have trend reversal. Trend reversal is obvious when price gets rejected at a certain level. After rising up for so long, it stops and it reverses. It doesn't just do a choppy little pullback. Price reverses, and when price reverses, you can look at these candles and say to yourself, well, do any of them, ring a bell, or any of these obvious candlestick patterns that I can recognize as I'm trading? And sure, a lot of them you can. Typically on reversals, you'll see a large wick. And that just means that they were testing out the sellers in the area. If you're in an uptrend and you see a very large wick to the upside, then what they're doing is they're testing to see if the sellers are awake. You know, are the sellers around? Are there any sellers that are looking to keep this price from going in a further direction up? So right here we'll see coming up on this uptrend, you'll see, you know, this large bodied bullish candle, right, and a decent wick, nothing crazy, but it stretched out a little bit. Now you see some people call these pin bars. This would be considered a doji, right? This doji price was relatively the same between open and close, but there was trading up and below it. So what you do, you go and you back test a chart and you take a look at it from inception to where you're currently trading, and you find the major reversal points and you look at those patterns and you say to yourself, okay, are these repeatable patterns? Is this something that I see often enough where I can start recognizing them as a price action trader and say to myself, do I think I have an idea of what could happen next based off of just what I'm seeing? So if we were in this uptrend and we painted these two candles here, the bearish candle came in and it had that fairly long wick, and you said, okay, well, you know, I'm going to hang tight for a second. That's not enough for me to kill this uptrend. Say, no problem. So you're going to watch it, and that second candle gives you an indication that, okay, you know, the bullish trend is currently exhausted. If only temporarily, you don't know. You don't know if this is going to be a major reversal, if this is going to be a pullback. So you watch the candles. And this next candle, this third bearish candle here, right? That's, you know, that's an actual candle, you know, with an actual name to it, but it's a hammer candle with a little bit of an upper wick, you know, a little bit of an upper shadow. But the body is what tells you down here they're testing the buyers. And by testing the buyers, I mean the buyers are what gives you your uptrend, and the sellers are what gives you your downtrend. So if you see a very large wick to the downside, what that tells you is that they were testing the buyers out by pushing the level so low, and the buyers responded by eating it all up and leaving very little body left over. So in other words, they reacted. And even though it's a bearish candle, it's a reversal candle. This is actually a bullish candle. It's bullish because the psychology behind that candle tells you that the bears pushed it as far down as they could, but the bulls responded and they ended up winning. They ended up eating it all back. And that being their candle at the end of close, by not allowing it to go any further and closing down here, well, now they have all the momentum. And you can see that in the next candle. Momentum's on their side, it's on their side, it's on their side, and they keep going. Now, right up in here, we have ourselves a tiny little symmetrical triangle, which in a bullish uptrend, right, you're painting yourself a pennant, right? So it's a bullish pennant. And these are other things that you'll recognize as a price action trader, because this is considered a continuation pattern. So if you have a bull pennant or if you have a bull flag within the context of an uptrend, it's considered continuation. So, and that's how this one played out. You continued, you traded back up, you went sideways for a little bit. If you look at the candle definition, right, how you have your low, you have a higher low, then you have a higher high, and then a lower high, and a lower high. Again, this is a tiny little pennant. Now, this is on the daily chart. If you looked at that on the 30-minute chart, it would look like a huge pennant. Okay, but just to give you perspective on the daily chart, this is a pennant that played out. And another bullish pennant, and then up we go. Now we get to this top marker here, right? Another large candle. Say, okay, with a bit of a wick up top. But what tells you there could be a problem is this indecision candle. This is a doji. Now, we've seen a doji over here and over here and over here. The difference is with this doji, this is in the context of a pennant. Now, this doji here would have been your first indication that you need to be cautious of a reversal. And this next candle saved you from getting out of that trade. This next candle was, don't worry about it, everything's fine. You know, let's keep going. And as you painted that next candle, you said, okay, well, now I'm starting to build a pennant out here. I got to ride the pattern out. And the price went up. Now, over here, you're not building any pennant. This next candle comes in, and you say to yourself, okay, well, you know, how long can I stay in this trade and keep hoping that, you know, this is going to be continuation. So as a price action trader, right here, you start getting the idea of, okay, we might be going into reversal zone, but I can hold my trade and see if we're going to make another higher high. And that's when you go back to that global sort of trend here. And they don't get bogged down with the intraday or the intra-trade micro trading. They use those for entries and exits, but they don't necessarily hop out of a trade at the first sign of, you know, a bullish candle. So price action, it's not that it's considered conservative trading by any means, but you're not exactly grabbing the top and you're not exactly grabbing the bottom. You're very comfortable inside that 80% trading zone where a trend has already been declared and you're sort of riding that trend until the trend changes, and at which point you simply turn a buy to a sell or vice versa. So for a price action trader, he's got this indication here and he's riding this down. And if he's looking at micro trends, he's going to say, okay, well, you know, I got a pullback here, and this pullback is fine. Price shot back up, but okay, right here, I failed to make a new high. So now he's got to start saying to himself, all right, well, you know, failing to make a new high, I'm gonna pull out some of my profits right here, and we'll let a little bit ride. If it does end up coming back up here and I make a new higher high, I'm all cool. If price goes down, I'm gonna give myself a level, and if it goes past lower than that level, I'm out. And that's what they would do on intra micro trading. So in this micro trend over here, he would have this level pointed out from previous trading. This was the high. That's that candle that we looked at just before that brought down and made this big giant wick. That's his previous level of support. And we would have drawn that when we were doing support resistance. This is an area of a pullback, but it's still significant in the fact that it was trading. The fact that you came down and you tested that area again and found support only gives you verification, or you're only validating the fact that that is an actual level, a level of interest for support and resistance. Now, when price came back up and ended up cutting through it and failing to use it as support again, this was your idea to get out of that trade. Okay, this zone right here. And then you went sideways, you chopped a little bit, you tested another new low, and now on the micro side of things, you ended up getting yourself into a local or a micro downtrend. Now overall, you're still up, okay? On the micro level is where you took your trade, and you ended up exiting the trade because you got caught up on these micro levels. A lot of price action guys and girls won't deal with micro levels. They look for major levels. And they could be trading on a 30-minute chart, right? But they're still looking for major levels within that 30-minute chart. They're going to have the same type of choppiness in here because you're still dealing with minute candles, 3-minute candles, 5-minute candles, 15-minute candles inside of a 30-minute candle. But what they're dealing with is these major swings, right? Swing high, swing low, swing high, swing low, right? And because of that, These are the levels that they're looking at. These are what they're making their trades off of. Now, if they're looking for entries and exits, especially if things get dicey, then yes. That's when we start getting into the micro trends over here. And that's similar to something like hidden pivot, where you're getting in where nobody else is getting in because you're getting in on a micro impulse of a much larger move. So I know we're lagging on the stream, so let me know if so far this makes sense, and then we'll go a little further. We gotta figure that out, the lag though. That's terrible.
Hey, what did you ask me?
So I was saying, if you have any questions up to this point, and if everything we just went over, if that makes sense, then we'll move on.
Yeah, I had one question is where are you looking at for like entry levels and exit levels when you're looking at trading these levels? Like I know on like a very basic level, but like where would you identify like this is where I would enter a trade and this is where I would get out based on price action?
Okay, yeah, no, that's a great question. So, based off of price action alone, you're looking for breaks or continuations of major trends, or major swings, I should say. So, if we start right down at the bottom here, right, we're not worried about this was listing or whatever. We come down and we find a support level. Trading instantly goes up. Trading got stopped out right here. So I'm gonna sort of paint this as we go along. So trading got to this level. After that, price changed. Whoops, we don't want that. So after that, price changed. It reversed. And even on the daily time frame, we could say, okay, just if we're looking for entries, then we're looking at micro trends. We're looking at local trends. So we made ourselves a low right here, which is a higher low than our previous low. Trading comes up. We made ourselves a high. Price reversed back down. This high was not higher than this high. So now we have to start saying to ourselves, okay, well, we might be looking to make a lower low. And at this case, this is where we start drawing some lines. We're going to say, okay, if we don't have ourselves a higher high, then what do we have? My dog's going crazy. Sorry. All right. So let me zoom in on what we're looking at here. Got like even the chart's crazy laggy. We're working on it. We're trying to make things better. Okay. So now we can sort of focus on what we're seeing. So for entries, for price action traders, you look. Cheers! All right, so for price action trading, you're looking for levels. We're on a daily chart. So we're looking at whatever trends we can find inside of our next major impulse. Now, since we haven't made any trading yet, right? We're only right here as far as trading is concerned. All of this doesn't exist in the future yet. So we don't have a major trend that we're playing with. We only have this particular price action. So we say, okay, we had our low down here, right? Price reverse. It was an obvious reversal. Okay, so we take this and we say, all right, we're gonna make this support level. Price comes up and trades up to this level up here, and we say, okay, well, price stopped, right on this wick. It got up to this level, and it couldn't trade any higher. It came down. So now we made a low. This low is higher than this low. Okay, so what we're looking for next is a completion of an uptrend. We're looking for a low, a higher high, a higher low. The next would be a higher high. And that would say, okay, now we're in an uptrend. But what happened was you failed to make that higher high. All right, so let me get this out of here just for 1 second. When you fail to make that higher high, then you have to start looking at, well, what if I'm in consolidation? What if I'm going sideways? And if I'm going sideways, right, then this next level over here is what's going to give me my determination of what am I looking for into the future. I know, as far as my high is concerned, I need to get up over this previous high. And I know, as far as lows are concerned, I would need to get lower than this low. These are my first two areas of major trading, major reversal. All right. So with this low painted here and this next high that came up here and price started trading lower, now this candle here is what tells me, okay, now I got a higher low, a higher low, and a higher low. I got a higher high and a lower high. So now is when you start breaking out the drawing tools. You say, okay, well now I know I'm going to have some type of trend. If I connect my lows to one another, I say, okay, this is what I'm looking at as far as my trend is concerned. And then if I do the same thing on the other side, I can say, all right, this is what I'm looking at. And I'm looking for something to cross these levels. Now, this is a little exaggerated because of the height of the wick and the level of the next bar of trading, the next high that you got in there. And because of that, because we went through doing trends, we could say, okay, well, does this even make sense? Right? Do I want to keep this, or do I want to see if any of these other trend lines make any more sense than this right here? But we're going to keep it. We drew it. We're going to keep it. This is the level of your highest high. This is the level of your lowest low. This is your next low. So you connected the two and you got yourself aligned. So now you have a trend line to work with. Anything lower than this trend line means you lost support and it's now resistance, right? This resistance line here for your downtrend means that anything that comes up over this is finding support. So on the trend line going down, we had a crossover here and nothing happened. There was nothing parabolic. There were no breakouts. This wasn't a pattern that we were drawing. These are trends to get ideas. When we shot through, we just went sideways. There was nothing significant here, but we did sort of ride this trend line down a little bit, right? You're still at this point, you're no trade. Right? Nothing has indicated any type of trend for you, and that's why you don't have a trade just yet. Right now, you're on the sidelines, and you're still waiting to see what's happening. Now, you made another level here, right? This was your low point, and then you had 1, 2, 3, 4, 5, 6 days of trading up. So you said, okay, well, that's a level, and I'm going to draw that line. Say, okay, right here. Now I have this to look at as far as price history is concerned. And at that point, you can say, all right, well, do I need to change any of these trend lines? Nope. Everything is still sort of right where it's at. But this low does make me feel a little bit better than this drastic low to low. See all this space over here where nothing was really happening? Well, let me see how this looks. So what I'll do is I'll take the trend line and I'll move it to my next low over here. And I'll say, let me take a look at this, and let me take a look at this. Now let me see, does anything look okay? We got one, we came down, we popped back up, and now we have more trading that we're watching, and we're watching, and we're watching. And now we're finding support on this trend, a little bit more so than that last one did. It was a little bit sharp. This one is a lot more horizontal, less of an angle, less aggressive. This trend line to me looks a lot better. I'm staying on this trend line. So now what I'm looking for is this level. I'm still back to that high. The fact of the matter is we have not made a higher high. So if you're looking for any type of bullish indicator, you need to cross over this high. And again, like we said, if we're looking for anything bearish, we need to get lower than this low. All this range trading in here, this sideways stuff, is doing nothing for us. And it's doing nothing for us but making us wait. Right? And like I said, we still have no trade. Now, this trading came down. This trading came down. We like this trend line, but this trend line's over. Okay, this trend line didn't do anything. So we're watching. We got more trading, more trading, more trading, more trading. This level right here, we made a high, and then price went down. So we say, okay, finally, I can get rid of this trend line here. I can say, let me come over here, and let me see if this makes any sense. Okay, so with price action trading, your biggest, I don't even know how to word it, but you're always based off of time, right? You can't do anything until the next candle shows up. So this whole time right here, you're just waiting. You're just waiting. You're on the sidelines. You have no trade, right? Like I said, you need to get higher than here or lower than here, and you haven't done that yet. Now at least you can start painting a pattern. Right now you can at least say, okay, I have a symmetrical triangle. Trading has given me something I could draw. Prior to that, it gave you a lot of nothing. But now, as far as price is concerned, trading is concerned, right now at least you have a trend line and it looks like it's being respected. And down here you have a trend line and it looks like that's being respected. Now, you have your symmetrical triangle drawn. On a breakout scenario, if you were already in an uptrend, then you could say you could take the trade on the breakout. Unfortunately, because we just picked up this chart, it just got listed, we don't have a whole lot of price action or history to go by, we're still waiting on this high. All right, so as a price action trader, you're disciplined. All right, you're not trading this breakout. You want to, but you're not going to trade it because you have not made another higher high. Now, what happens is you break out, you go to the north side, that's great, here you go. Now, this candle, this guy right here, this candle closed above your last higher high. So finally, you have made a new higher high. And at that point, now you're looking for continuation of trend, and on your next low to be a higher low than these lows that you made down here. So your higher low, your higher low, your higher low. You want to make sure that you have another higher low after you make your next higher high. So trend is continuing. It's continuing. It's continuing. It's continuing. It's continuing. You got this massive candle here, this massive candle here, this massive candle. Bang. Right here, you get your high. And of course, you wouldn't know that until the next candle is painted. The next candle painted is lower, right? So now you say, okay, finally, I made myself a high. This is my next major swing high from this last major swing high. Now, mind you, you're in this trade, right? You got in this trade right here. Because you made another higher high, you got in the trade bullish. And you're in the trade, and the price pulls back. You say, oh boy, here we go. You know, so you're watching it trade, you're looking at levels in history, right? And outside of these, you know, listing levels on the first few days, there's not a lot of history to go by. So you give yourselves a target of, all right, well, you know, the body close of the last major candle. And your body close of the last major candle is this level right down here, right? And that second candle, the bearish candle that got painted, was fine. Nothing wrong with that. You had a little bit of trading up, not much coming down. Next candle, body traded up, lots of trading up. Trading came way down, but if you gave yourself a little bit of cushion room, right, you would have been okay right here. You'd still be in the trade. You basically just kissed it, but typically you would give yourself, you know, a little bit of room underneath. So in other words, if you're going to front run or hang in a trade a little longer, you would have still been alive in this trade. As price action trader, you want to give yourself time to stay in the trade and see if you form any type of patterns, right? So right now you're in a long trade. Now you got price went up pretty significant amount. You're starting to finally see your first pullback. Pullbacks are totally normal in trading, and that's why, you know, when you look at whenever anybody's, just like we did earlier, whenever anybody's talking about a trend, and they say, okay, well, you got price, and it looks like this, and this is what a trend looks like. Okay, this is your pullback. This is your pullback. It's totally expected. And there's nothing wrong with that. Price cannot just go in one direction forever. It's just, it doesn't happen. So more often than not, you're going to look for some type of pattern. So what you have is you got a wick up top, a wick up top, a wick up top, and then a little bit lower, 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 and the same thing on the bottom side. You had this large wick down here and then back down here. Overall, trend is sideways to down just a tiny little bit. You can almost get in there and call it a bull flag. It's a little choppy for a bull flag, but you know, you would still be in this trade until you made a low lower than your last swing high. So this level, or if you were going by your candles, right, the previous candle support, would keep you in this trade. And these candles are painted, they're painted, they're painted, they're painted. And because we were looking at what candles tell us and what candles look like, you painted yourself a bit of a spinning top, not quite a doji, on this reversal. And so you're watching these candles and you're saying, okay, I'm still in this trade until I get lower than, you know, this level here. I'm still in it, and price moves up, flattens out a little bit, and then goes up, 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 up. Okay. Now you finally have yourself another higher high. So you come over here, you say, okay, that's cool. I made myself another level. So now you have your first low. You have a higher high. You have a higher low. You have a higher high. You have a higher high. A higher low. And trading continues. At each one of these levels that you've created and you've crossed back over, that's validation that you're still in that trend. This is what you need to do in order to get to the next level. So you need to cross this high in order to be in continuation of trend. If you hit the high and you fail, then it's what we talked about before, and it's failure to make a new high. What happens often is you get a double top. So you find resistance on your previous swing high, and it's a double top and then failure. So double tops typically will fail and break down lower, whereas a double bottom will fail and break up. So on the smaller micro trend, I forgot about this little guy down here, right? This is another low, another higher low, and this is a higher low. So now you wouldn't have to draw all these lines as your trading price action. Most of that would just be a visual thing for you, and it'll only be when it's appropriate. You know, like all these lines would be gone by now. You wouldn't care about any of these lines. What you care about is what's happening currently in price action. So this is your new high. This is your new low. You need to make sure you make another high that's higher. The second you got this candle here, you know, all right, even if this thing closed right here, it's going to be higher than this. So I know I'm still in continuation. Continuation, continuation. Trading stops. It stalls. Bit of a pullback. Comes back up. Reverses up. Okay. Trading. Stop. You got your pullback. And when you come back up, right here is when you fail to make your new high. So at this level here, this is where price action traders start saying to themselves, okay, I need to know what's going on. Am I getting out of this trade? Is it just a minor correction and then we're going to make another higher high, or are my eyes set on possible reversal? So exhaustion in trend will be your first indication that you fail to continue the trend. And this candle right here, and based off the next few days of trading, you know that you fail to make a new high. You fail to break that level that you've already created. Now you have to start thinking of possible reversal. When trading comes down, and right now you made another low, this was a higher low, you say, okay, trading comes back up, and you make a lower high. And trading comes back down, you broke previous low. Now that you broke previous low, now you have to start thinking, what are you going to do? Okay, this is a level of support. This was a level of support, and you failed. Because you failed, now you either sold short or you're out of the trade. You're out of your long trade. Okay, so like I said, you're not finding tops, you're not finding bottoms. You didn't close the trade up here, how could you? There's no way for you to know if that next candle was going to be a bullish candle or a bearish candle. You need a few days, right, of trading for this thing to decide, all right, did I fail to make another high? Right, you won't know that right away. So like I said, you're not finding tops, you're not finding bottoms, but you are trading in a relatively safe zone. So yeah, you didn't get out over here. You made yourself a low because you failed to make a new high and then price reversed. That's your indication, get out of the trade. This area right here. Because price reversed without making the new high. Okay? So once you had a price reversal and you came back up, so now you saw that, now you're already out of the trade. You saw this level over here and you said, all right, well, I have a level of resistance. If I break above it, I can watch and see if it's able to push past that. I might go long again. If it comes up into the zone, makes another higher high. It didn't. Price went sideways and then it broke down. Now you're looking to go short. You're out of the trade. This was your level. This red line is your level. You come down and you close below this level. Well, now you're looking to go short. Right? Now you're so far away from making another higher high. What you need to do is start making a lower low. And you do right down here. You made this lower low. Now, as a price action trader, you're looking at this level. Okay? Because now you have some historical data that you can go off of. Major swing highs and major swing lows are going to be areas of interest in future trading. So now that price is reversed and now it's looking to go low, you're looking back here to say, all right, well, am I going to find support on my previous high? Or am I going to really crash this asset and it's going to continue to go down and down and down? Well, it didn't even hit these levels and you found support, right? It didn't even hit the level. Didn't even get there. So you would be waiting to see. You could have sell orders over here and you would have gotten in the trade because you broke previous lows. You would have gotten that trade short and you would have been looking at a profit target, your first target right here. Right? You never even made it. You never made it. You know, so not that it was a failed trade, but you never made it. If you got in at this level right here, trading came back up, kissed your level, and came back down, that would have been a pretty good indication of further downside. But like we just talked about, very often you'll have double tops and double bottoms. This isn't quite a double bottom, but it is possibly close enough. Nah, it really isn't. I'm not going to stretch it there. So you're talking 705. You're talking a low of 7 on this candle. Let's see. Yeah, so your low was 7. And this candle was your low. Low was 710. It's a 10-cent difference. I don't know. I probably wouldn't call it a double bottom. Other traders might. And if that's the case, you found support and it kicked back in a reverse direction. Now again, you're back to this level here. This same level that got you in the short, and you found resistance on it. You ended up coming back down. Again, you're not making higher highs. You came up. You got this level up top here. This is at least a higher high, all things considered, for these 3 candles. You came down to find a little bit of support, and then you shot back up again. Still looking, just like we did when we first started. We were looking to make a higher high. Still haven't made a higher high. So this level on the bullish side still doesn't exist. We're still waiting for that. You came over here. You came right back up to that top and you failed. So now you come back down. You came back down to that same level here and you failed. So what can we get out of all of this? Right? We could say that we're range. Right? We're sideways. We're not exactly making a trend, except for on this very local side here, we can say that we made a higher low, a higher low, and a higher low, and a higher high, and a higher high, and a higher high. So that being said, you'll have traders that will draw this out to give them an indication of, if price does X, I'll do X. So what they're saying when they got this on a micro level, they're looking for entry. And what they're saying is, if price, right, breaks below this support, I'm going short. And right here, it broke below, right, and closed below. So they would have went short. They would have been wrong, unfortunately, because there's no trading where you're 100% right. Okay, that's just how it is. So they would have been wrong here, and they would have gotten out of the trade up here. Right? Capital preservation would have taken you out of the trade. You would have cut your losses, no problem. You would have kept going, and you would have gotten back in over here. Right? And you would have stayed in the trade. You're still below it, but you're trending up. So at whatever risk level you were at, you would have gotten out of the trade again. So that's twice now you failed on this same trend line. All right? Then you start trading above it, above it, above it, and you break below it. And right here, you would have gotten short again. And that's based off of just this trend line. Now, that being said, because you have more data to work with here, right, you can start seeing, well, was I even in a trend? And you can say on a local level, I had a high, and a high. So yes. If I ignore the noise in between, then yes, I had myself an uptrend. And this is something very important for price action traders to realize when you're in a trend and what trend is acceptable. What are you going to consider noise, and what do you consider actually being in trend? And that's where it comes down to, what are you trading? What time frame are you trading? Are you trading the hourly? Are you trading the 4 hour? You going intraday with a 15 and a 30 minute? You doing 5 minute price action? You doing daily swings, weekly swings? And that's where all this would be considered noise on a daily time frame, right? But on a 5 minute chart, this could have been a ton of patterns, reversal patterns. You could have had 1,000 different things happening in here that you didn't even know about. So that's what you have to be mindful of, and you have to be disciplined as far as what are you calling a trend as far as your time frame is considered. If we look at global trend, like we were talking about earlier, we're still waiting to make a higher high. Well, while you were dancing around this trend line, what did you do? You made a higher high. You made this high, this high, this high, and this high. And this high would have been your next high in your larger trend. Because this was your first high, and you were looking to make a higher high. And you did. This was your higher high that you made. So you have to pull yourself out of what I call, or what everybody calls, tunnel vision, and get yourself out of, being right up in the intraday stuff. Unless you're looking for entries and exits, right, what you're looking for are major swings. Major swings. Okay? So, on a major swing level, this was your last major high. This, right, would have been your major low. This would have been your next major high. This would have been your next major low. Now, if this low isn't higher than these lows, well, then you have a problem, and you're no longer in an uptrend. And that's what happened. So you made yourself, if you look, you got 1, 2, basically almost 3 touches, right? So On the larger scale of things, you could say, all right, well, you know, it's a double bottom, triple bottom. And at that point, you're saying, all right, well, am I going to reverse up? You know, I'm still, now at this point, I'm looking for another higher high. I'm looking for something higher than this high level here. And if not, I'm looking for something lower than this level here. Because these are your last two major indications of a swing high and a swing low. Anything in between that is noise. It's garbage. Now you can find patterns inside of there, but until you break one of these levels, right, you're not in trend. You're just not in trend. You could be in a sideways trend, but that's about it. So you have to let trading happen. Trading happens. It happens. We're looking sideways. Come down a little bit. We retest these levels. We retest this level. We fail. Come down. We're sideways. Oh, we're trending down a little bit. Trending down a little bit. Oh, what's this? We found support. Now this is what's called confluence. Confluence is when you have an area of support or resistance, right, from a historical trend line or historical support at the same time. So right at this zone here, right, we could say that we had support from this swing high, and we also found support from this old trend line down here. So we left the trend line on there because I wanted to make a point to you before. I said you could delete all this stuff because you're not looking at it. That's 100% true. But if you're going to do that, you have to be mindful of keeping your chart in a larger view. Because visually, you can see this. Say, hey, look at the angle of this trading. Look at the angle. Oh, wait a minute. That's an old trend line. That's a historical trend line. And because you have your swing high here, right, you had that bottom right here, you're looking at that as confluence. So this gives you the idea that, all right, you definitely have support. You have support in two ways. You have support from a swing high, previous swing high, and you have support from an old trend line, historical trend line. And because they sort of meet basically at the same area, you're saying, all right, I have confluence. I should definitely find support here. And you did. You found support. You traded just below it, you know, a little dancing around, but you came right back up. It was okay. Now you're trading on this line. Now you made that low, right? This low right here could have shook out a lot of traders because it's lower than this low, right? You made a lower low. So now you got to start saying to yourself, well, okay, well, what are we doing here? Let me connect those two lower lows and see if anything happens in the future. So you will, you know, you'll draw this line out and you say, all right, well, if I have any trading that's going to come down here, I'm looking for support. Okay. Now we could see into the future, so we know that, you know, nothing like that happened. But you still want to get into the habit of at least saying to yourself, all right, there's a possibility of trading to happen. You know, I want to protect myself on support levels and see what goes on here. Now, because we failed to make a higher high, failed to make a lower low, we know we're not in an uptrend, we know we're not in a downtrend. Now you can start taking some of these intra levels and you're going to start finding yourself some patterns. Say, all right, well, I have this trend line here. I could draw this. Right, and I have a low, low, low. I got this low, and I got this low. So I could connect these two and see if that gives me anything in the future as far as trading is concerned. Trading comes down here. You know, we already found that trend line. Found support on the trend line. Right, we come back up. Now I'm crossing over this level. So if I get rid of my historical trend line, and I get rid of this low, and we get rid of this, it's just clogging things up. Now because I drew what would have been a symmetrical triangle, it broke low, okay, but still not lower than my lowest low, so I'm still not trading. I hit this lower low here, and that, at which point I'm starting to say I might go short on this. Okay, I might go short, but I don't have any confidence yet. Need to make another lower low for that to happen. And that hasn't happened. So, price comes up, comes down, finds support. Price comes back up. Now I'm riding this trend line here. Okay, this trend line works because it's on a local trend. It's a micro trend from the trading that we are right now because we're sideways. Like I said, this is our high, this is our low. Failure to make a trend out of either one of those two just puts us sideways. Yes, we did have this low here, but we're waiting for our next low. And we're still waiting for it. We still haven't got it. So we have our new trend line here that we're drawing. Not exactly a great symmetrical triangle, but it's a pattern nonetheless. It gives us a visual idea of where trading is. With this trend line here, of course, we broke below it. Trading. Now it's acting as resistance. So we can say, okay, these levels, these trends make sense. Trading comes up and it breaks over this trend line, your uptrend line. It breaks over that trend line. You also broke over this downtrend line. Okay? But you're still not in the trade yet. Trading comes up, and as expected, it gets to this high again and fails. Okay, so you're glad you didn't get in that trade yet because you're glad I need to break this level. And the second you break that level, you can go in and go long. Price comes down, price comes back up, breaks through the level. This candle, it closes above your higher high. At which point, you go back in long. So you set your buy orders up right here. You end up going long on this trade because now you're making another higher high. Bang. You made your higher high. Right here. Price reversed. It came down a little bit, not much, just to this level here, and then it reversed again. So this was your pullback. So at this level you had your pullback, you came back up, you broke through, you made another higher high, now you have confidence in the trade, you stay in the trade. Price comes up, you're not worried about this level here, it pulls back, unless you go lower than this level, you're still in the trade. Price pulls back, price ends up going back up, and up and up and up and up and up and up and up. And right here, you would say, all right, well, I made another higher high because I just watched price reverse. So price reversed, it comes low, right? You find a little bit of support over here, comes back down, goes low. You made another low, but this low is a higher low, right? Higher low. So what you have in this trend is a higher high, higher low, higher high, higher low, higher high, higher low. Now, just like we said before, double tops and double bottoms. You're going to see a lot of them. So you have a double top. Just about. Didn't quite make it, but that's close enough for daily trading. So at this point you say double top, okay. Now since I know patterns, I'm going to say I'm going to look to go short. At this point here, you could have gotten yourself out of your long trade, or you could have taken a portion of your long trade out and sold it and waited to see what would happen. Your level that you'd be looking for is this swing high level right here, your last swing high. So price came up, it came down, it actually hit your swing high. So if you didn't give yourself a cushion, you would have been out of the trade right here. If you gave yourself cushion, then you would have been okay and you would have stayed in the trade. Now, if you didn't consider this swing high as important, right, your next major swing high would have been down here, and your next major swing low would have been right here, then this level would have never shook you out. This would have been okay. Just a clear pullback, right? So you would have stayed in that trade if you were trading off of your latest swing low or your major swing high. Okay, so trading would have continued. What would happen right here is an area of significance because you had trouble going over it before. You made a double top. So right here you have to be a little bit wary If we get up over here, I feel pretty confident we're still long. Price trades up, only a little bit, comes down. Now this is what's called a first touch. Trading came up, and then you retested. You flipped. Resistance, and you turned it into support. Typically, you like to have a retest. It's called your first touch. Now, you would like to see a first touch and a spring. That didn't happen. You ended up getting a first touch. You came back up, and then you ended up doing just a double bottom. And then you sprung up. Okay? And just like trading just always continues. You know, so bang, here you are. You made a level. Price reversed. You said, okay, well, that's my high that I need to beat. Until I beat that high, you know, I'm not in an uptrend. Right? So price comes up, bang, right here. You made yourself a low. So now you have your high. You got a higher low. And you got a higher high. You got a higher low. You're looking for a higher high. Didn't make it. So this was your failure. So, because you have a failure here, now you have to start saying, what kind of failures is it going to be? Am I going to find support on my previous swing high, which is this level right here? Right? Or am I going to fail through it? If you fail through it, you're going short. Okay, right at this level. So you already have your level based off of these highs. Right, you play it short just a little bit. Since you had trading down here that reversed up, I would probably put my buy order just below that. Give it a little breathing room. And the second this price comes down here and lower than that low, lower than these swing highs, guess what? I'm going short. Bang. You would have went short right here. Trading would have continued. Now, instead of higher highs and higher lows, you're looking for lower lows and lower highs. So price comes down. You made yourself your first low. You got trading comes back, a little bit of a pullback, lower high. You come down, you have a lower low. Trade back up, a lower high. Trading continues now. Here you failed to make your lower low. So you break out your trusty trend tools. You wait for something to form as far as candles are concerned. That'll give you at least something to look at. See, a lot of people want to start drawing trends on the first two candles, and you have to be patient. There's nothing there to draw. So you say, all right, you know, this is what you're currently looking at. You say, all right, well, I made a few levels here. Now I can start, you know, seeing if there's a trend. Right, so I got my lower low, I got my lower high. So right here you're still good. Right here is where you failed. Right, because this was the area that you failed. You take your lower low and you take your failure point and you connect the two. And you look for the break below that. Right here. And this would be the area that you short. So you also had yourself a symmetrical triangle. You'll notice those are fairly common all the time because it's within the context of a downtrend, right? You could call this a bear pennant, even though it doesn't have the exact argument of a bear pennant. Because it's a symmetrical triangle, people would still call it a pennant, but typically you'd like to see a pennant much wider trading to much narrower trading, and not so much this is sort of riding the top and then riding the bottom. So, you know, a symmetrical triangle, if nothing else, but it's an ugly one at that. But the important thing to remember here is you take your lower low and then you take your failed low and you draw a trend out of that. And when it breaks below it, you continue your short. Okay, so right at this point it broke. You continue your short. You're looking for a lower low, lower than this low. You know you have it. You continue to trade. Bang. You made a lower low. So at this point, you mark.
I have a question when we get a break.
Yeah. Go ahead. What do you got?
Okay, I'm in a certain point of the video. I don't think it's caught up to you yet, but I'm looking at that one support line. Looking at ETH right now, you'd go long if you were a price action trader.
Well, on a micro trend, right? You're not going on a macro trend. You're not going long until you're up over here, right? This is your failed high. So on a micro trend, let's see what you have here, right? You just came off your low, you made a low, made a higher low, and you made a low, and then you went into consolidation. You broke consolidation, you went short. You're short, you made another lower low. At this point here, although this is a large retracement, unless you break this low, your previous swing low, you're still short. I'm going to put that as a different color. Okay, unless you break this previous low. Oh my god, this freaking... Sorry, this computer's killing me. Okay, let's get this where it needs to be. Bang. All right, so I made it blue just so it's easier to see, because now we just have far too many lines for price action. It's just disgusting. Like to keep it super clean. There we go. All right, a little bit better. So, levels that we're concerned about here. All right, you would get rid of this too, but you used it, but it's out of here. Okay, and let's get rid of this. All right, this is your lower low. This is your higher low. You broke. You made a new lower low. Unless you trade above this horizontal line, you're still short. That's the risk of price action trading, is you allow a lot of breathing room in between trades. Because you are trading on trend, you are currently still in a downtrend. Very much in a downtrend. So there would be no reason to flip long here if you were price action trading. If you were on a 1 hour chart, probably. 4 hour chart, probably. Because you got this small level here, right? You broke over that level. That would probably give you indication to go long. But on a daily, no. On a daily, you wouldn't be going long here. In fact, now that you have price data built in, you have history, now you would do this. The stream will get better. Everything's just super laggy. Okay. You would do something like this. Now that you have price data and you have enough to give yourself a respectable trend, you would put that trend up there. And this would give you confluence, right? Again, it would give you confluence. So this level is your most important level currently. If you break over that, you would be looking to probably go long. Until then, you are very much in a short. You have a lower low, and a lower low. You have a lower high. This whole area is a lower high. You have a lower high, and you currently have a lower high. Right? The second this becomes no longer a lower high is when it's higher than your previous low. Right? Then it wouldn't be a lower high, it would be a higher low. And in this case, if it was going to be price reversal, right, it would end up being your new high, and then you would be looking at a higher low and a higher high. So this zone is where you start getting ideas for support resistance on an intra level. And you can see like this level right here, you could say, all right, well, this would be an obvious level for support. This right here, price sharply reversed after being up for a little bit. This would give you an idea of levels. But for price action trading, like I said, you're not finding tops and you're not finding bottoms. You have to be disciplined enough to stay in a trade even if it doesn't look like it's going your way. Now, if you design your own rules under price action that say I'm willing to get out of a trade once I've made X amount of percent profit, then you do that. So let's say you were short. Where did we go? We went short where we failed to make right that high. So we were short at what, this level? Level, thing on over right here. So I think we went short right here. So if you were short here and you rode this whole thing down and down and down and down and down and down, you know, you're well into good percentage range here as far as profits, right? So let's say even you got in super late. We got you in at 643 and you're currently trading down at 81. So well, you're talking 641 to $81, right? That's ridiculous. If price were to come back up and you started getting nervous about the retrace, saying the retrace was too much for you, you just get out of the trade. Or you would pull enough profits out to just leave, you know, basically free money or casino money. You would leave that on the table and let it ride. And then if it does continue down, which is what you would expect to see in a downtrend, you would expect this move here. Price comes down, price comes back up, right? It either hits previous low or finds rejection, and then you make another lower low. This is what would be expected as far as any trading is concerned, right? We're in a downtrend from January. So if we look at like we said before, if we're looking at macro trends, if we're looking at the big picture, then we would say this is what we're looking at. That's our high. That's our low. That's our high. No, it's an ugly, so it would be more like that. That's your low. That's currently your high. And you would be looking at something like that. Give or take. Based off of, now this is an Elliott wave, even though that's the indicator I use, but that's just to be able to draw a couple impulses easily. You could do a couple different things here. You might stop it here, right? And then because you went over here, this ended up being, you drew that trend line that looked just like that. And you took the short after that, which brought you to this low. Okay, but at the end of the day, it's still a downtrend. It's a downtrend. A trend always wants to stay in trend. That's what a trend always wants to do. It's always much harder, and it takes more energy, and it takes more volume, and it takes more of everything to reverse trend. Now, on a micro level, reversing trend is no big deal. Reversing an actual trend is a big deal. Okay, so for us to reverse trend and call this bullish after January, you need a new high. You have to have a high higher than your latest swing high, right? Your major swing high. This major swing high is at $1,594, $1,594. We're currently trading at $155. So we're clearly in a downtrend. 100% in a downtrend. For us to start getting bullish, you have to start taking out your previous swing lows and your previous swing highs. And you have to march your way up that ladder so that you break this level. Whoops. You have to break this level. You have to break this level. You have to break this level. And these are sort of intra levels, you know, they're important, but they're not crazy. Even this level here is somewhat important, and that level. So until you start breaking these, right, you would have to come up here. Okay, you broke that level. Let's say you did a little retest down here. All right, you come up over here. Okay, Now you broke this level. That's good. All right, you come back up. You make another higher low. Swing back up. All right, you broke this level. And this level. And this level. All right. You come back down again, a little retest, and then boom. Right here, you did it. You made a new higher high. Because that's your previous highest high. All these intra levels will help get you there, right? And you could call this a local uptrend, but you're not in a primary or a major uptrend until you take a step back and you look at your trading. And that's why looking at these charts as for what they are in a macro sense gives you a much better indication on where you actually are as you're trading. You know, all that intra stuff, you're looking for entries and exits. You know, for your actual trend, I mean, this is your trend. You're up, higher low, higher high, higher low, higher high, higher low, failure. Right here. Right? That was your failure. That is almost your most important level on the way back up. Because this is the level that started the downtrend. This is the level that destroyed your uptrend. This zone right here, this is what you have to break. You absolutely have to break if you're looking to make another higher high. Okay, and I don't mean that just obviously, like, of course, you can't get higher without passing through it. I mean, psychologically, this is the level that created your downtrend. That's the level that took out all of this. All right? So because that level is so important, right, when you start sneaking up to it, that is when you're going to start seeing people taking profits. People are going to pull out, short the market, or short, you know, that particular asset, because they know it's an important level. And they know you failed on it before, and you didn't just fail on it, you created a downtrend over an uptrend that lasted, you know, for what, a year? Longer? 2016, 2015.
What's up, brother?
Oh, man, what's going on, Scout? What's happening?
Just about to get home. Sorry if the connection's bad. I will talk to you.
Yeah, no problem, man. Sounds good. Sounds real good. Yeah, so that's why that level would be, you know, significant, more so than some of these little intra micro levels. And that goes for any time frame, though. Anything that reverses course at such a magnitude that literally creates a reversal trend is going to be highly important coming back to it once you reverse trend back and you start going into an uptrend from a downtrend. Of course, you're going to be looking at those levels and say, all right, well, this was the level that knocked us out. This was the one that failed us. I think for Bitcoin, I think it was 17.5 or 17.6 was that first drop after 20. That was the pullback, and at that point, that was your failure to make a new high. Right? You didn't go past 20. You got stopped out at 17.6. It could have been 19.6, whatever it was. That is your level of concern, and that's going to be the hardest level to get over. But that being said, you have a whole bunch of levels in between there. Of course, you have 66. You got 44. You got 72. You got 86. 94, 96, 10, 2. Like, these are all important levels because they all make sense for trading. But they weren't the ones that started the downtrend. They weren't the ones that created the reversal in such a way to take a trend for so long and kill it. So that's what gives it significant weight. I'm just trying to clean this stuff up in the meantime. Going back to being in that downtrend, right? And you made a major trend line here, which is allowable for price action trading. You'll use trends, you'll use channels, and patterns. Like we talked about triangles, and you'll use falling wedges, rising wedges, symmetrical triangles, ascending, descending triangles. Some of those will have reversals to them. Some of them will have continuation to them. Coupling that with what you see on the chart, coupling all of that with previous swing highs and swing lows as far as support and resistance levels, that is price action. That's price action trading in a nutshell, is using very little, but basing everything off of just what the chart shows you. You're using no fundamental analysis. You're using no lagging indicators. No RSI, no MACD, none of that. This really comes down to patterns, candlesticks, and trend, horizontal support levels. And although we did it on a daily, you do it on whatever time frame you want to trade. But you have to give yourself enough history to understand your macro trend and to understand your local and micro trends. So if you say, well, I'm an intraday trader, I only trade on the hourly chart, fine. But give yourself enough data so that even on the hourly chart, you understand what type of trend you're in. Because it may not be the same as a daily or a weekly. We saw on the daily chart that we were in a clear downtrend, right? I'm only going back, so many bars here, but we're going back to October, right? But this will give you, this is on the hourly chart now. So let me get rid of this because this is on our daily chart. If we're on the hourly chart, we already have different patterns. Right off the bat, somebody might say like, oh, well, you got a cup and handle. You got a W. You got a bit of a W pattern going on over here. You got a step down, sideways step down. So right here you had a symmetrical triangle. So you got a lot of different patterns that are going to show up because you're on a different time frame. Inside this macro trend, right? So this low to this high to this low to this high, right? This here gives you, an impulse, 1, 2, 3, 4. But inside all of this is your micro stuff, right? Up, down, up, down, up, down, up, down. These are all your entries. If you missed your entry, your reversal entry down here, you get in over here. You missed it, you get in over here. You miss it again, you get in over here. These are all micro trends. Micro trends inside of major impulse legs. So on the hourly, you're going to say, all right, well, my macro trend would be up, right? Locally. It's a local up, but I'm still in a major down because this is my high and I'm trading lower than that high. All right, so it can get confusing, but you just have to take a step back and say, what type of trend am I in? What type of market am I actually trading? Or am I just going sideways? Right, so if this is your high for your price history, this is the data that you're looking at. Say, this is my high, all right? This is a pretty significant reversal right here. So you say, okay, this is my low. This was my high.
What up, what up?
Yo, what's going on? So I made a lower high, right? And then I come back down. This is pretty sharp right here. So I made another low. So a lower low and a lower high. Okay, this is a downtrend. Now, failure to make my next lower low is price action traders are going to take a look at that and say, all right, well, I'm no longer in that downtrend. And when you come up here and you make a lower high, you're still in that downtrend. When you come over here and you fail to make a lower low, or that lower low is basically a double bottom, now you have different patterns to look at. So a double bottom is going to be a heads up alert for you to say, okay, I'm looking for this to go bullish, or I'm at least looking for some type of reversal. So this support has played out in a way that your last lowest low acted as support. You found support on it and you bounced off of it. Now that triggered your double bottom. You wouldn't be playing that double bottom, right, until you crushed your latest swing low, which if you said this was your low at this level here, this was your previous swing low, then you're not technically taking this trade until you break over that level. Now once you break over that level, yeah, you're in. Now, like we just talked about before with first touches, right? It ended up breaking the level and it came down for a first touch, right? So this is the point where you would want to get into that trade with confidence. If you were going for an aggressive entry, you would have gotten in right at the break. If you're going for a conservative entry, you would be waiting for the first touch. Because if it fails and comes down, right, and breaks through that level, you wouldn't be taking that trade at all. That's why it would be more conservative. You're waiting for the actual entry. If not, then you would be waiting for candlestick patterns to indicate that, yes, you are certainly making higher highs and higher lows, at which point you're back in a local uptrend and you can continue to ride that long. So this section right here is you just went long. As a price action trader, you would have just went long. Right here, you made a higher high, higher low, higher high, higher low, higher high, higher low, higher high. Right at this level here, you're saying, okay, well, I should make a higher low and a higher high. The second you fail to do so is, as a price action trader, you got to start saying, well, am I looking to reverse? Your levels of interest, now we can zoom in because at that point you would have gotten your macro trend, so you would be okay with being able to zoom in and deciding what the hell's going on here. So now that you can see what's happening, you come up, you make this high. Your latest swing high, because you were doing intra levels, is right here. The second you close lower than this level, that means you failed to make a higher high. And instead of having just a failure, this is a non-failure. This is even worse because you didn't even find support on your latest level. You blew right through it. Not only did you blow right through it, you smashed through your other swing high. This would have been an area where you said, all right, well, at least I'd find support on my last swing high. Well, you didn't. You crashed right through that one too. And trading ended up going just about to your third previous swing high, which was this level right here. So now it did find support. It actually found support when you went sideways over here, which is not irrelevant, but it's noteworthy to an extent. But I don't think anybody would have actually traded off that. Most people would be on this high, and that would have been their target for support. It came crashing down. Now you're out of the uptrend, right? You're clearly out of the uptrend. And you swing down, you made yourself a new lower low. You come up, you make yourself a new higher high. You come down for another higher low. So wait a minute, are we back in the uptrend? No, because you failed to make another higher high at this point here. So just like we did on the lows, when you failed on the downside, you took your lowest low, right? And you took your failed low, and you ended up drawing a line there. And that gave you an indication of, if price does this, I do this. So if price, let me get this on here. If price crosses over this line, I'm going short. Okay? And that's what would have happened in this scenario. You would have came down because you failed to make another higher high. You know you're out of the uptrend. And because you failed to make a lower low, right, you're out of a downtrend. So what are you doing? If you're not in an up and you're not in a down, you're sideways, If you're sideways, you're consolidating. So when you're consolidating, you take your lowest low. You know, if you're going for a downtrend, you would take your lowest low and your failed swing low, right? And you would draw that line. And when you draw that line, you say break below that line, and I'm taking it. So just like we took the break above that green line in the last example, and we failed a few times on that trade, this one panned out. You ended up taking that. You would have taken it short here. You would have rode it. Right here, you flipped support, turned it into resistance, and you would have rode it down to this level down here. Once you saw it starting to go sideways, right, you would have to hang tight here while you draw this pattern, because that's actually it's a little bit of a bear flag coming down on a downtrend. So if you were to take the micro trend and you would have played this, you would have been looking for that to break lower. It didn't. That's why no TA is 100%. Unfortunately, this did not pan out. But you would have taken this trade down to this level here, and once you broke above this candle height, because this was part of your trading, then you would have gotten out of your short, right? You got above this highest high right here during this down. You would have said, okay, I'm out of the trade. And you would have been looking for what is the next level. Now you would have this massive spike up, which you were no part of. This line, of course, you wouldn't know at the time because none of this trading would exist. But look how well this line works for current trading, for current trend. Now this is again micro because we've zoomed in. Now we're only looking at data that goes back to, you know, the 19th as opposed to October. But you could have kept this line up here as an area of possible relevance, especially here once you saw resistance. You saw all of the, or not resistance, support. Once you saw all of this support, this gives you a clear indication, okay, this level makes sense for now. Let me ride this. But we're still looking for higher highs off of this level up top, and we haven't hit that yet. So that's what we're looking for. So
Hey, Mr. Chingas.
Yes, sir.
Can we talk about something real quick? As
Yeah.
far as drawing the trend lines go,
Mm-hmm.
we were discussing this today, me and Skinner and a couple of others, about when you set your trend lines, right? I don't know if you touched on this, but there's a big difference between trend lines drawn between the extremes, especially on the higher time frames, and the bodies, right?
Yeah, of course.
There's two very valid arguments to either. Extremes are where price could go, and bodies are where price is and was, right?
Well,
Um,
price always
extremes,
was at the wick,
well,
no matter what.
yeah, but
We're just
extremes
talking
at
about
the
open and close
no,
between a specific time period.
no, hold on. No. I'm sorry, I stated that wrong. You know, extremes, right, are the wicks are where price touched, right? But the main trading goes at the body. Now, I like to get both and see which one is more valid. And for me, that's volume to volume. If there's wicks that have the volume, that's where I draw my trend line, right? But it makes a huge difference.
I teach trend lines that the trend line has to make sense, and if you have to force the trend line, it's probably not a good trend line to begin with. So,
Well, that goes with that goes with what I'm saying is, like, you know, volume attracts volume. So you want it to make sense. Exactly.
yeah. So if the wick makes sense, then I'm using the wick, right? But if the wick doesn't make sense, I have no problem cutting through that wick. I've cut through bodies at times because for me, zoomed in, it was a fake out. And if it's a fake breakout, then I don't care about that trading and it's not valid. So I would blow right through those bodies, even though that would make some traders turn over in their graves. The fact of the matter is, it's a well-respected trend line post breakout. So I'll cut right through those bodies.
Yeah, and that's one of the arguments there is like right now, what you have drawn is you can see those breakouts, and I like, as opposed to you could fake yourself out and not realize those breakouts, you know, and that is important because that's, if you throw volume on your chart, I don't know what you're looking at, ETH, right? If you throw volume on your chart, I guarantee you're going to see some confluence between your trend line and the volume as to where it's drawn, and Super, super important.
Yeah. So like for price action won't look at volume, or very few price action traders will look at volume. But price action traders do look at trend, and they look at overall trend, and they look at patterns. So this trend line would have been drawn here for price action rules that dictate that if you're no longer in a trend, right? This is where we lost our high. So because we lost our high here and we failed to make a higher high and we broke through our previous highs support level, now we have to start looking for what may be reversal. And by painting this low here and coming up and making a high, which of course failed to be a higher high, now you're looking for a lower low. And because this low off a reversal failed to be a lower low, now what we can do is we can take our lowest low, our failed low, and we connect the dots. We draw this line. Now none of this trading would exist yet when we draw this line. So it would look like this. Boom. It would look like that. So trading happens, right? We make our lower low, make a high, which is now a lower high from here. And we say, all right, well, now we're looking for a reversal. We're looking to go low. If we don't get lower than this level here before reversing in price, then we have a problem. We're not in trend anymore. We're not in an uptrend. We're not in a downtrend on a micro level. Of course, yes, we're in an uptrend, right? Local on the big side. So the second we do this, we would draw this line. Okay? And once we draw that line, we would say closure under that line, and I'm going short. And that's exactly what would have happened. Closure under this line, and we would have went short. Right here, for a price action trader, you'd go short. And again, you would ride that short down until you found significant resistance or support. So right at this level here, you would expect to find support, and you didn't. This was a previous swing high, and you found no support at all. You blew right through it. Okay, no problem. You're going to continue to trade in this little mini double top right here. This is what knocks you out. Yeah, it seems a little ridiculous, but you have to go with what the candles give you. So I would have let the trade happen and continue to go lower, because I'm hoping that this is drawing itself a bit of a bear flag. And if that's the case, then I would expect it to break lower. So I would stay in that trade. The second we traded above our highest candle in this little segment is when I would have gotten out of the trade. So I would have gotten out of the trade right here. Now, if I felt confident it was going to reverse, then I would have been back in the trade. I could have went long once we made this higher high. And once we flipped this previous high's resistance. But if you were waiting for candle closure, you wouldn't have gotten in until up here. At which point, I would never go long, because you just had that level of support turn to resistance. So that would be a tricky one for any trader. If you're going in on candle closure, this would do you no favors. You wouldn't want to get in right at resistance. Now, in this case, it worked out fine. You blew right through it. But that's not always going to be the case. So to have specific rules for when and why you draw a trend line, and when and why you get into a trade long or short based off of what price action tells you, that's what you want to consistently trade with. As any trader, not just a price action trader, but any trader, you want to be able to have rules and then follow those rules. And you will not be right 100% of the time. No one ever is. But as long as your risk is in tune with what you're trading, and you're right 30 plus, 34% of the time, if you're 2 to 1, then you're a profitable trader. So that's what you want to look at for these specific areas. Now, you could have drawn yourself a symmetrical triangle if you wanted to. And you would have seen this play out once you drew this line here, right? You wouldn't have enough data to draw this second point. And about the time that you would have drawn that second point, you would have already broken. And according to your rules, you would have already taken this trade south, which again would have been a profitable trade. So that would have been good. Once you crossed above this line, you have two things to look for here. One, now this is historical trend line, right? So now you just flip from support to resistance to support. But now you're looking at previous highs, right, from your micro trend, right? This is the little intraday bullshit in between your much larger trend. Again, on your larger trend, you're looking for a higher high, higher than this level, right? Or you're looking for a low, lower now than this level, which is now your new lowest low. When you swing back up here, you have to decide, are these levels important enough for me to play off of? And this particular level is, for the reason that it was a previous swing high. It also caused a reversal during this little intra trading over here, right? And that was actually the reversal that brought you your short. So this level would be an area of interest. When this pricing came up over this trend line and ended up popping up over this line, this is an area of significance where you could say, well, I could go long right here, or I can wait for a pattern to show up. So which means you'd be sidelines trading. Now, this is a diamond pattern here. You could see how price expanded. You know, it started narrow, it expanded, right, and then contracted. Right, so you got yourself a little diamond pattern. So you could take your little diamond pattern thing here and kind of do like one of these puppies. Right, and this gives you an idea of, reversal trading or continuation. Diamonds are notoriously one or the other, basically 50-50. So it wouldn't give you any indication on where to go next, but with confluence on this trend line, you would hope that it would be going long if you respected the trend line. It broke below trend, so you would have been no trade, especially because you got confluence on this resistance line right here. You know, you'd say to yourself two things. Well, if we break below it, I could be looking to go short. Also with a break low from the diamond, I could go short on this, which if you did, it wouldn't have been a great trade. But because this trading is a little bit insignificant, probably would have been no trade at all. So these areas here would have been no trade. Back to the trend line would have given you an idea of where micro trend is going. Micro trend with your high and a higher low based off of this low over here. Trading comes up. Now you finally broke your previous swing high before your local all-time high. At that point here, finally, you're looking back at this level. And you're saying, all right, if I can get above this level here, I can maintain course. Failure to get up to that level would have gave you an idea of reversal. Okay, would have reversed down. Now at this point here, because you found support on this trend line, you could play this trend line. Right, 1, 2, 3, 4, 5. By that point, now you're 6 times on this trend line. It's a valid trend line. And at that point, you could trade off that trend line if you want to. Price action likes to have trend in mind, or at least a clear consolidation, which on a micro level, you have a micro uptrend. And that's what you would be playing off of. You'd be playing off of this low, this higher low, this higher high, this higher high, this higher low, this higher high, and this higher low. Failure is this candle that just painted itself a few hours ago. That's your failure candle. This candle right here on the 1 hour chart, and this may not be represented on a daily chart, but on this 1 hour chart, this failure candle is enough to make price action traders say, all right, I was in this long, now I'm gonna wait for reversal. I'm gonna watch for reversal. If this comes back down here and finds support on this trend line, and comes back up to make another higher high, then I'm okay. Right, that fail was just intra-trading, and I'm cool. I'm going to continue to trade. But now you have to be higher than your last high, which you just created a few hours ago. That's your new higher high. So now you got all your lows and you have your highs. Now, as a price action, you're going to say, all right, well, I might have a channel here. And that's what you're going to draw. So you say, all right, well, I'll take my lows. I'm going to see what we have here. And if I connect my lows, I'm going to say, all right, well, this is terrible. This is nothing for me. So again, like Scout was just saying, if it doesn't make sense as a trend, then it doesn't make sense as a trend. Right? So at this point, you would say, all right, well, I'm not even touching here. I'm only got one touch here. I'm cutting through these wicks over here. Does this even make sense? Does it even look like the trend that I think I'm making? And with this breakout down here, right? Is this doing me any services, or is the trend that I already have better for this particular trading? So that's a decision you're going to have to make as a trader, and every trader is going to look at it a little bit differently. Some traders might leave this trend line on here. Me, I might come over here and say, well, let me get a little bit more historical. Not historical. Let me get a little bit more current. And let me take this body over here, because this is basically a breakout. It shook down, shook back up. I don't like drawing trend lines on breakouts, but if there's enough of them, if there was a third one here, I would feel good about it. But this whole trend line here, I'm getting rid of. I don't like this as a trend line. I like the trend line that's already there. I'm going to keep it. Now I'm going to connect my highs. And I'm going to say, all right, do we have anything going on with our highs? Do we have any type of indication that I'm either in a channel or a wedge, or I have anything significant that I need to look at as far as trading is concerned? And it's a bit of a rising wedge. It's not dramatic in the least bit, so I would probably get rid of this as well. It's also a pretty bad channel if you're looking at channels, so I would get rid of that. So what do? Just like we did with our last two examples. The second you fail to make that next move, right, you're going to take your last high and then your fail, right? So you're in an uptrend, so you're going to draw the tops. We're going to take our high and our failure candle. And now here's two ways to play this. The second price breaks over this line, you go long. Or the second price breaks under this line, you go short. All right? And that where, as a price action trader, you have to say to yourself, right, you're basing this trade off of current price action on a local non-trend, right? You were uptrend, but you failed. Right? You failed. The uptrend's over. You failed. This candle failed you. So because of that, if you find support down below, you break up over it, you go long. If as your support that you've been using this whole time fails and breaks, then you go short. And then you look for the next lower low or the next higher high, or a continuation and consolidation. So for consolidation, you have your higher high, your lower high, your higher low, your higher low, your higher low, right? And this would give you a symmetrical triangle in, let's see, a handful of hours, right? You would be out of that completely. The pattern would be dead at that point. As you get closer and closer and closer to the apex, it becomes weaker and weaker and weaker. Breakout for symmetrical triangles should be between 50 and 75% of the pattern. So if this is your pattern, you'd be looking at breakout basically right where we're at, a little bit further, maybe up until 4 o'clock or so, January 7th. I believe that should be, yeah, so it'd be 4 p.m.
Quick question.
Yeah, what do you got?
So are trend lines always supposed to act as support?
Or resistance. Yeah.
Right, yeah, like support and resistance. Okay, so that's what we're drawing them for, is to act as like confluent support and resistance.
Yeah, so confluence would be, when they intersect with your horizontals. So here's a horizontal, right? This section right here is confluence. So you got confluence with your trend, and you got confluence with your horizontal support resistance from a previous swing high, right? So when you're doing, when we talked about horizontal support and resistance the last time, right, you were allowed to take those levels from just about anywhere, as long as it looked like trading made sense on those levels. For price action, horizontal reverse support and resistance, you were very much looking at swing highs and swing lows. And usually on a larger sort of macro um, trend, right? So you would not trend levels. So like this level here is very obvious reversal, bang, you would throw a level here. This level right here is very obvious. The price stopped, it reversed up. Okay. At the top point of there where it reversed down, yes, that would be a level. This would be a level. These would be levels down here. Of course, this double bottom is significant. This level up top here, where you wouldn't so much pull it unless you were looking for entries like we just were, you wouldn't really be hitting up this swing high and this swing high and this swing high and this swing high. You get the idea here. Your trend here, right, on the hourly, but with enough data, is still this, right? You know, it's not significant to the point where you're worried about all these little intra trades. Okay, that's basically what your trend would look like, and those would be your significant areas of interest, right? Like this level right here, this is your lower high because you're in a downtrend. You got a lower low, you got a pullback, lower low, you got a pullback, lower low, trend reversal. Now you're up. You're not in an uptrend yet. You have to make a higher high, a higher low, and a higher high. Then you would be in an uptrend. This higher high that you technically made only by dollar count isn't really significant enough in the eyes of price action, right? This would more or less be a double top. So if you're trading hourly, you still need to keep this in mind because this is your trend on the hourly chart, right? So you pull back enough data so that you can make a macro trend, right? This would be considered your primary trend, right? And then you would have intermediate trend, and then you would have what I call local. I think the textbook would call it minor, and some people will call it micro. So these little levels, these little impulses, right? This little higher high, higher low, higher high, higher low, higher high, higher low. This is all built into this one move. This one move up is built up of all these tiny little moves. And this is where Scout will talk to you about like hidden pivot. So like hidden pivot, you're coming in at this level down here, where nobody sees you coming in at these levels down here because this level doesn't make any significant sense in this trend, right? But when you zoom in and you get down to the nitty gritty of it, well, yeah, you got yourself a pullback, but within that pullback, you have an ABCD, that which is your typical. An ABCD is just your impulse, right? So you got your A, your B, you pull back, right? Your C. Oh, hold on, your C, and then oh my goodness, C, and then your D, right? So this would be typical trading on an impulse level, and inside every leg, you can break those up, 1,000 more times and find all these tiny little impulses. But because of that, you pull back enough data to give yourself an overall trend. And an overall trend right now, you're trying to make an uptrend. You're trying. You have yet to succeed in making that uptrend. You do have yourself a low, you have yourself a higher high, you have a higher low, and you're working on a higher high. But for all intents, or for all, whatever the saying goes, this, you'd be looking at a double top. And then that's typical behavior for a double top if it pans out. You would have a double top and then failure and a break to the downside. Your significant levels would be, this little impulse leg down here. If I could draw it properly, would be nice. So that would be a significant level down here. And this would be a significant level over here. Of course, the magnet's on, so it's like pulling it in a bunch of different ways. But these would be areas of interest if you were to fail here. Okay? And then if you were to fail there, you're looking at breaking this leg and going short. Okay? So every time for price action trading, every time you enter a trade, when it comes to larger trends, you're just looking for a break in the trend. And it's easy. You're just setting up shop at a previous level. And it's either going to be support or resistance. If it fails, then you're going to take it the other way. So if it was supposed to be support and it failed, you're going short. This level right here is your resistance level. You need to break above that on the local time frame. Now your next major significant level going up is going to be this area here where it failed to maintain a high. Okay, but you were in a downtrend. Now if you look at the micro part of it, you're in a downtrend. You had your high, you had a low, you had a higher low, and you had a lower low. So this area right here where it failed, that's your next level of resistance that you're going to come across. Now, I think we drew this earlier, but this is the same thing where you had your low, and you didn't have a lower low. So this was the same deal. You take your lower low. It's never going to let me do this. Let's see. Maybe? All right. Well, anyway, I'll just do it like this. You take your lower low, and you connect it with your fail low, and you trade the breakout. Okay, so without zooming in, this would be the idea down here. You had your low, you had your fail to make a lower low. You draw the line, you trade the break. So you would have taken this trade south, right here, if you weren't already in based off of price action up top over here. This was your high. This was your fail to make a new high, right? That would have been this would have been your higher low. That would have been your fail to make your new high right here. Because you failed to make that new high the second you crossed this line, you would have taken that trade south. Let me zoom in on that so that you get a better idea on how that works. But that's typical. This is typical setup here. Of course, we didn't see all of this price action when we were just doing that, but that's all right. So just based off of just what we were just looking at, this is how this works over here. You got a low, right? You got a higher low. I'm sorry, you got a higher high, you got a higher low, you got a higher high, you got a higher low, just barely, almost like a double bottom. And then this candle right here, you failed to make a higher high. Okay, so now you go back and you say, all right, what was my previous lowest low? Right here. And as my previous lowest low, since I failed to make another high, if I break this level, I'm going to short it. So if I close below this level, I short it. So inside one of these candles, you probably closed. Let's see. Doo-doo-doo. Yeah, for sure. You definitely closed. So you would have taken this. It would have swung back up. You would have gotten a little nervous, but that's all right. Your stop at this point would have either been your previous failed high, which would have been this guy up here. Which is not at all where I put that thing. Come on. Right there. Okay. So that would have been your stop loss, or you would have, plus or minus a little bit, depending on how aggressive or conservative you are. But you would have taken that trade right here. Would have closed below, you would have went short, came up a little bit, resistance, support, resistance, whatever. It failed, it broke down, you took it. All right, you took that whole trade. Now you're in a short. You're in a short, and what did we say the last time? You're in a short, price stops, you have to start thinking, am I going to stay in this short or not? Right? At this point here, you need to make a lower low, right? Because now you've just started a downtrend. All right, price reversal, failed to make a new high, broke previous support, down. You're in a short now. Now you need to make a lower low. Price retraces, comes over here. Okay, you made a lower low. It's almost a double bottom, but you'll take it. You're still in the trade. Price trades back up here, comes down here. Right here is where you have to decide, do I want to stay in this trade or not? Okay? Failed to make a lower low. Failed to make a lower low. All right? So at which point there, now I tried doing this from a super zoomed out point. That didn't work out so well. So we take our failure candle, we take our previous lower low, and we just connect the dots. We close below this line, we're going short. Okay? We could take our highs in a micro trend. All right, and we could put these guys together. We can say, okay, we kind of have a symmetrical triangle within the context of a downtrend, gives us a bear pennant. So it gives us the idea that this could be a bear pennant, although it's super ugly and it's basically riding a trend and less of a pennant. You'll take it and you'll watch it, right? But trading below your failed candle, you go short. Breakout, you're in. You're in this whole trade. You're in the whole trade. And you're in that whole trade coming from a short. You were already in. Okay, price stops real quick, just for a second. Bit of a pullback, continues down. Now you're at this level down here. Price pulls way back. You get a little nervous. Still in the trade. Come back down. Oof, double bottom. All right, so this is where price action traders, again, they have to make a decision. Do you trade it as a double bottom? Okay, or do you stay in the trade and see where price takes you? So most people will take profits on whatever short that they were in, and they would let some ride for the setup of your next trade. So let's take both scenarios. Let's say you completely let it ride. Price came down, price came back up. This is your new higher low. Price comes down, lower low. You're in it. You're still cool. Okay? No worries. You got your low. You got your lower low. All right? You're still in the trade. This is a pullback, although a scary pullback. Right? For the amount of trading that just happened, you say, well, was it too much? Well, not necessarily. Even price action traders will use Fibonacci retracements. Right? So you take the impulse leg, measure it out. Right? This is not against the rules for price action. Come down, what'd you have? A bit of a 382. You didn't even hit the 5 on the retracement. No big deal. You're still in that trade. Right, that trade is still short. Trading comes back up, make a lower low, right, you make another higher low, lower high. Come back down here, make another low, another huge pullback, You come down here now, this candle. Now I know you know by now, failure, right? That's a failure candle. You had your lower low, that's your failure, right? So right away you could draw this line. Right away you could do this. So, all right, regardless of whatever else happens, I have this line, and according to my rules, I break below that line, I'm going short. Okay, right now you're still in the short, right? Right now you're still in the trade, and you wouldn't know to think about anything until this candle, the next candle. And you said, failed to make a lower low. So now what do? So price comes up. So, oh man, it's not going to stop. Bang, price reverses. Once price reverses, now you know these are what price action look for. Reversals. So say, oh man, we reversed up here, all the way up here. So now what do? So now I got a low, I got a higher high. Got a higher high based off of previous lows, right? That crushed through my previous lows. Look at that, we crushed through this level, crushed through this level. Right, these are the levels that are important for price action traders. These are your swing lows. You say, oh man, all right, well now what do? At that point, you should be out of the trade. You should have been out of the trade right here. If you let trading get up to that level and you didn't get out, based off of previous swing lows, this is where you would have gotten out of the trade. Okay, like I said, price action, you're not looking for tops, you're not looking for bottoms. You're looking for reversals, right? But you're not getting in at the bottom, and you're not getting out at full reversal. So right here, you would have been out of the trade, but that's one hell of a trade. Okay, you took that trade from way the hell up here. Just on this leg, right? That's still a great trade. All right. Well, let's say you did take that trade. You would have been $174. You would have went in. 116. You would have gotten out. You take your little short position tool here. You would have said, all right, if you got in right here, and you brought that down, and even if you didn't play the whole bottom, and you waited for that next level to knock you out, right, 30%. It's great. 30%. So anyway, you would continue. Let's say you're out of the trade now. You still have this line here that you drew. This is your failure line. And you know you close below this line, you're going short. You have your failure line here. Now you have a high. You come down, you make another higher low. So 1, 2, 3. Now you're looking for a higher high. You're looking for a trend reversal. Okay, higher high would give you that ABCD. That would give you that impulse leg. What happens? You fail. You fail to make a higher high. So now you have this. Now you have your higher high. And you have your fail. Well, come on, magnet. Do your thing. Okay. So now you get a break above this, and you're going long. So break below here, you go short. Break above here, you go long. Price consolidates. It's not a great symmetrical triangle. It's not really a trading symmetrical triangle at all. In which case, you might want to draw yourself another line as trading is happening. As you see trends, you can draw them. So this, now, you have a falling wedge. Okay? So you would take that falling wedge. Price has finally broken out below your failed candle. You're short. Now you go short. You're into this short. Price stops. Price pulls back. Price fails to make a lower low at this candle. So now at this point, we've gone over this long enough, right, where you would know, okay, I'm either getting out of the trade or I have to watch and play my cards right. But you would draw this line because that's your swing low to your failed candle. Break below this line and you're going short. Like I said, it doesn't work out every time. You would have taken this right here. Price would have failed short. Closed down. You would have taken the trade. All right. You would have traded sideways a little bit, depending on your stop. You probably would have gotten stopped out. All right. Now you're well over here, and you're going nowhere, and you're basically trending up. All right. So this could have been a losing trade. Capital preservation would have taken you out with nothing more than a 2% loss, and you're waiting. The price comes back into the triangle. Nothing changes. Right? Close below this line, and you go short. The rules are simple. Bang. Okay, so you've lost this trade. You won this trade. Okay? Right here, again, you made a lower low. Pull back. Failed to make another lower low. All right, so at that point, you could have gotten out of the trade. Or you could have rode it to see what the next few candles would have given you. At that point here, trading below this line, you go short. You come up, so now you're looking for an uptrend, right? Because now you have a higher low. So price is low, price comes up, you got a higher high, bang, you got a higher low. You need to get up over this level to have an uptrend. Price comes up, now you got a higher high. Okay, at this point, now you're in an uptrend. So you would have, this is what you'd be looking at. 1, 2, 3, 4. Technically speaking, the second you broke this high, you could have went long. Okay. You had your low, you had your high, you had a failure to make a lower low. So this is now your low for an uptrend if you make an uptrend. All right, so that's your low. This is your higher high. This is your higher low. The second you crossed over that higher high, you could have went long. You made your new higher high. New higher high would have been up here. You would have had a pullback. It came down. Failure to make another higher high. So again, bring our little tool out here. Now we're going backwards, right? Now we're in an uptrend. Okay, see how that works though? You trade above your failed line, you go long. You trade above it, you went long. Bang. You got a pullback. You got a higher high. Bang, right here. So this is those non-failures. Right? This is where you blast through as support. These are more significant. Like we said, came over here, you made your high, you had your pullback, your higher low, you had your higher high, right? And when you came back here, right, when you failed this line and this line in the same move, that's significant. And that's where you want to get out of the trade or reassess your what the candles are telling you. If the candles are telling you sideways, stay in the trade. Maybe you got like a couple spinning tops, some indecision. No significant trading marks. Then you might stay in that trade. If it's showing you, bearish candle patterns, then you might want to get out of that trade. If you look at the whole thing and you have a much larger pattern that you're dealing with, you might stay in the trade just because of your latest high, higher low, higher low, higher low. Maybe you feel more confident in this trade, at which point now you could draw trend lines and say, all right, do any of my trend lines make sense? If I start connecting my lows and I say, all right, well, do I have anything here that's going to show me that this was support? Was there support coming over here? And you did it. You found support. I would have stayed in that trade. It's easy to say from hindsight, sure. All trading is. But just based off of just that, I would have already had a trend line up because I don't wait too long to draw them. For any trend, for any line, you only need 2 anchors. That third touch is what makes it valid. So I would have said I would have probably started drawing down here, at which point the angle would have been so sharp that I would have readjusted. So I would have had something down like this originally, just based off of, today's data. Like this is all I have to work on until I get some more candles. So I would have had something similar to this, but knowing this market, a trend line that non-aggressive probably isn't going to get you very far. So this trading would have happened. This trading would have happened. I would have already had this trend line drawn here, right? Because now I got a pretty significant high and a pretty significant high. I don't know where the hell this thing's going, so it just gives me indication. Turns out that one works out just fine. Once this trading came down here and made this little W, that's when I would have said, all right, this trend looks a hell of a lot better because that's more in tune with this other trend line. So I would have taken this trend line and I would have moved it over here and I would have gotten rid of the bottom of it, and I would have done something that made a little bit more sense. Something similar to this, although I don't like cutting that off on the corner. But in retrospect, I guess we could look at it and say it kind of worked out. So this is more of a channel. It is a little wider at the bottom, a little narrower at the top, so it's kind of like a rising wedge, but it's a gigantic rising wedge. So we'll call this a channel for now. And so that would have gave you confluence like we talked about before. This would have gave you confluence even though right here you failed to make that higher high. Failure to make that higher high. What do? Well, you already had this level of support. You already had this level of support. And the blue one is blue, so it must have been major. And now with your trend that you would have drawn from these candles and this candle cluster here, this is a three-way confluence. Right, so you got trend line confluence, and you got, well, two-way, because I would just call that support. So, and a horizontal support. So at that point, I would have stayed in the trade, for sure. Even if you didn't want to stay in the trade, you would have done this. Bang. Bang. Here's your high. There's your failure to make a new high. Trade above the line, go long. Right, trade above the line, go long. So we just continue to be in this trade. Now you have a channel to play off of, as well as horizontal support resistance, as well as candle patterns, as well as trend. So now you know uptrend, you're still in it, higher high, right? Higher low, higher high, higher low, higher high, higher low, bang! Right here you failed. Failed to make a higher high. So, it's all right, no problem. Take this. Ooh, that didn't work out. Take this. Like that. Okay. Trading above this line, I go long. Until then, I'm waiting to see if we're reversing trend. Okay. So, trading comes down. Whew, made a huge low. So now, I'm looking for a reversal. So I got this trading down here. I got a low. Trading comes up. I got a high, lower high. Trading comes down. Now I got a double bottom. Oh, now what do? Double bottom, I'm looking to go long. I'm not going to play it. I'm just going to be observant. Okay? Double bottom. It's also a W, right? But you'll understand patterns come into play as long as candlesticks patterns, head and shoulders, cup and handles, those types of things all are valid when it comes to price action. So this is a W bottom. It's also a double bottom. With the double bottom, you expect to see reversal to the upside. Reverse came up, but still failed to make a higher high. Okay? So failure to make another higher high. Look at where it found resistance on our trend line. So resistance on the trend line, trading comes down. This is sort of like a cup and handle. This little guy right here. Be a cup, pullback, handle. But it's ugly enough where we're just going to let it just be, a bit of a bowl bottom. or whatever they call that, little rolling bottom. Anyway, trading comes up, like we said before. This is your high. It's your failure to make a new high. Crosses above this line. What are you doing? You're going long. What'd you do? You went long. You got it. You got this. You got this. You got all of this. Now, not only are you back in trend, but you're playing the channel. So now that you have a channel to play off of and you're back in trend, you might be looking to either pull profits, front run off of this trend line, continue to wait and see if the whole trend plays out, or you can get out of the trade completely and wait for the next setup. Okay? You could get out of this trade and short it, expecting to find support on this line here. That's a dangerous way to trade, but if you're an aggressive trader, you would have been 100% out, and you would have short. And you would have shorted to the opposite channel. And then you would have sold everything, and you would have went long. The opposite side of the channel. Now, this would have screwed you here, right? Because you would have gotten out of the trade, and look, it continued to go up. Okay, so, like I said, you can't win them all. You simply can't win them all. But we continue on, right? You took the trade here. You're solid. You're up over. Now you got your higher high. You got your higher low. Trading comes up here. You got this wick. So at which point you might be hesitant. So you could say you would draw this line like we've been doing. You would draw that line and go long. Trading above that, and you're in. Okay? So you would have traded above. Bang. You're back in the trade. Right here, you would expect to see some type of resistance. Okay? Because this channel has played out fairly well. You saw no resistance. It's fine. You're not going to see it every time. But it would make me think twice, like, we might be coming back for a retest. Anyway, so we blow through it. We go long, make our new high. We come down. This is the retest we were just expecting. We got the retest, so we're still in the trade. We come over here and make a new higher high. Okay, we have our higher high here. Massive pullback. So if we zoom in, we could say candle by candle if you would have actually done anything here. It's almost too sideways to tell. For sure, when you're back in this channel, you would have said to yourself, okay, obviously, that is not a higher high. That's a pretty significant low. See what the retracement is, but it's support on a swing high from 2 swing highs ago. This would have been the area you were looking to find support. You found it all the way down here on this previous swing high. At that point, you'd either look for a reversal or look to get out of the trade. Okay? Obviously you didn't make your next higher high. You got stopped out right here. So to keep a tradition, you would take your high and your failed. Oops. There we go. And you would take your fail. Now, I always say you would trade above that line. The steepness of this angle would probably not, would probably invalidate that completely. It's just too steep. If it was far less aggressive like everything else we've done, where it's an actual, good-looking trend with respectable trading, you can't maintain parabolic trading at these angles. You can't. It's unrealistic in any market. So for that reason, I would probably ignore this line and just simply go back to basic price action, where I'm just looking for higher highs, higher lows, or lower lows and higher lows. At which point I would have a trend, or I would be looking for consolidation periods, which is what we ended up entering here, right? We had a low, a higher low, a high, and a lower high. So clearly these 4 candles give you, right, what would be a triangle, and at which case then you would say, all right, well, I'm in some type of consolidation, and I need to let this thing play out a little bit, see what I'm going to do. So it would be similar to this. So you have, you would have came down here at this point right here, right? You would have said, okay, I might need to get out of this trade. Um, so now you're lower than this line here. You fail to make your next high. This line here is a little too parabolic. So at which point, like, you might sideline yourself and say, let me not push anything here. Let me see what happens. You had your low. You got your new high. You got a new lower low. Okay, so maybe you're good, but
Quick question.
yeah, what's up?
So as you're moving through this trade, are you keeping your chart like this, or are you cleaning it up as you go?
I mean, for the most part, you like to clean it up. Time in between trades is so long, right? So for this trade to happen, right, we're on the hourly chart. So you're talking 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 13 is when you would have drawn your candle. 14, 15, 16. On the 16 hours when you would have taken your trade. So, yeah, I would have cleaned up this chart. What I would have,
Yeah,
what
because
I
I'm
would
just
have done,
I'm getting a little not confused. I'm understanding, I'm following, but it's like there's so much going on with the chart because of all the lines are starting to cross over.
yeah, for sure. You would do this, and I would recommend you would do this every day. Every day, you would come back to that trade on a macro level, and you would just take a look at your bigger trend. Because like I said, when you're doing that stuff, you're only looking really for entries and exits. Like, we would have been in the trade here for the short, right? You wouldn't have gotten out of this trade if you traded on the macro level. You wouldn't have gotten out of this trade until right here when you crossed over that swing low. All right, so you would have been in that trade short. All right, came down, bang, right here. Failed to make another lower low. Traded above your previous swing low. So on a macro level, you wouldn't need any of these freaking lines. You would have just said, all right, I'm in the trade. And, however many hours later it was, you would have gotten out of the trade. And that would have been your setup. So you'd be, oh, come on, oof. Oh, jeez, I gotta fix this stuff. Well, it would be a long time. On the macro level, on the micro level, that's where you have all those ins and outs, where you're like, all right, I got to get back in this trade. Okay, well, where can I get back in? And I think one of the most important things about price action trading is where are your entries? Where are your entries? Where are your stops? Where are your profit targets? This way, you have a defined trading setup and you have rules. You have, if I fail to make a new higher high, I take my previous high and I take my failed candle and I draw my simple line and I rock and roll. But yes, to answer your question, you have so many hours in between trading. Yeah, you would get rid of all of these lines. You would always look back and see if major swing levels make sense for your current trade.
Right.
You know what I mean? So you never want tunnel vision in trading. You never want to look at your chart like this for any significant period of time, unless you're really, unless you're scalping, or if you're looking for entries, or you're looking for exits. If you're zoomed in like this the whole time, you don't know where the macro trend is. You have no idea. There's no way you could.
Yeah, that makes sense.
You don't. The only support resistance levels you would have would be of what's of current trading. None of these would exist, nor that you would want them on there at all times on your chart. But none of those levels would exist. You'd only be able to draw them from recent price action, which is fine. But when
So do regular traders use price action with, or some traders use price action with other indicators and stuff, or like how would I work this into like other methods of trading, or like what tools would you recommend to add with that?
So, like for traditional price action, the only thing you would throw on your chart as far as indicators would be a moving average. Whether it be a 50-day or a 100-day moving average, or depending on the time frame you're on, because those are dynamic support resistance levels. Everything else is lagging. Well, even MAs are lagging. So don't get me wrong with that. But like an RSI is a lagging indicator. MACD is a lagging indicator. And because those indicators rely on price in order to determine how they work, right? You're already 1, 2, or 3 levels behind price, right? So you take your price, then you go to the next level, and it does an algorithm. That algorithm decides that it's going to spit out a number, and then that number is going to take that number and that number, and it's going to make an average of them, and that's going to spit out your indicator that's on screen. So you're 1, 2, 3 times removed from what you're already looking at right in front of your face. Nothing is more specific or on time or accurate or now than price. Price is now. Price is right now. Price is never lagging. Price is always right now. So because of that, price action traditional price action traders, from the way I understand it, they don't use indicators. Certainly not a lagging indicator. If they use any indicators, they would use an MA, some type of moving average that gives them dynamic support resistance. You know, you might have a 100-day coming here where this level didn't seem to make any sense, but little did you know it was the 100-day moving average. It found resistance, or the 50, and it found support. That's okay.
Okay, that makes sense. I threw on a moving average on one of my charts and popped over to it really quick, and it makes a little bit of sense with what you're talking.
Yeah. Now, also, don't get me wrong. Every trader is their own trader. If you have a system that works for you, no matter what the hell it is, you use it. You know, and you don't let anybody else tell you otherwise. You know, that's a fact. So if you use this type of price action with a MACD and your trades work, then you continue to do exactly that, and you don't steer from it until it stops working. I have seen a few price action guys throw on an RSI for confluence of where they are in trading. So they're in an uptrend, they're looking at this candle as a reversal candle, and they might pop the RSI on real quick and say, you know, am I up over 80? Am I getting near, you know, that zone where this thing is going to start spitting the other direction? And if that's the case, they'll just add that to their toolbox as a indication of possible reversal based off of candle, trend, and now RSI, just as confluence. You know, they're not going to trade off of it, but they're certainly going to add it to their toolbox and say, okay, this is just another reason why I'm taking this trade. This is another reason why I'm selling short.
Okay, so just confirmation on their idea. Gotcha.
Yeah, 100%. And like I said, don't let anybody tell you what you can and what you can't do. Like, if you want to trade traditional price action, then yeah, you're not going to use indicators. But why do you have to trade traditional price action? Trade whatever works, whatever gets you a winning trade consistently and pulls you out of trades consistently by saving capital, is the strategy you would want to use. You want to make
Yeah,
sure.
I'm just trying to like add some tools to the toolbox and see what I like and see what makes sense to me.
Yeah,
So
and I recommend
this helped
that.
a lot.
You know, I recommend everybody try to learn a little bit of everything, because I think once you find what resonates with you on on a more I don't know, mental, but just what resonates, what you're like, you know what, I dig this. If you just dig Fibonacci's and that's your thing, you're going to find a way to trade off of them. And you'll find a way to fine tune it, and you'll add in an indicator here or there that'll give you confluence on what you just did. You might use fibs with moving averages. You might use fibs with MACDs or TTMs, and that'll be your trade. That'll be your setup. And if that consistently gets you a winning record in profitable trades and pulls you out of trades quick enough to not lose too much capital, then that's the trading system for you. But I certainly recommend everybody at least get a taste of everything. This way they can make that determination. Say, hey, you know what? I really love support and resistance. For whatever reason, it just really makes sense to me. It seems easy. I can set my trades up, days in advance. If it hits this level, I go long. If it hits this level, I go short. And then just run with it. There's people that'll only trade MACD crossovers. And they might be right, 50 or 60% of the time. But as long as they get out of the trade when it loses fast enough where they're not losing a lot of capital, they're going to be in winning trades that'll get them, 5, 10, 15, 25, 30%. They're going to miss the top and they're going to miss the bottom probably by a margin of more than 20%. But they'll be in winning trades. Those MACD trades could last days, weeks, months, depending on the time frame that they're trading on. But you can swing trade on a monthly chart just with MAs crossovers and nothing else. And you literally put your trades in once a month and walk away. And like I was talking to you before about finding the macro trend and finding the micro trend for a monthly trader, this is all micro. Daily charts are micro trends to a monthly trader. He's looking at a weekly chart like, oh, look at all this chop. You know what I mean? Like, throw the monthly back on. This is too zoomed in. He doesn't care about any of that little trading. All this little step stuff inside of this hourly chart, most of that is just noise for a price action trader who's trading the 1 hour chart. He's looking for major swings. Major swing high, major swing low. That's it. That's what he cares about. He says, you know what? Until I get over this level, right, I haven't maintained my uptrend. I got my low, I got my higher high, my higher low. Where the hell is my higher high? This guy could be long all the way down here. And he hasn't made one adjustment yet. He's allowed this high to happen. He's allowed this pullback to happen. He's allowed this high to happen. And until, he fails to make that next high, he's still in this long. He would have gotten in bang right here. Right there, he would have gotten it. And he would have just rode it. And he don't care about this pullback. Some traders care about, they make 80%, and then bang, they say, oh man, now I'm only at 60%. I gave 20 back. Okay, well, you got your 20 back again. It's right here. You got it back. It's all right. Just be patient. So if you're confident in the uptrend, then he would have went long right here. Let's see. Bang. There's your lower low. High, cross right here. So he would have went long basically right here. He would have went long at $85. And now we're $155. So, what is that, 100%? Right? That's great. It's a 100% trade. He didn't do nothing. He didn't care about any of this stuff. None of it. None of it. Unless he got lower than $80, he doesn't care. This is all noise. Doesn't care about any of this chop. Doesn't care. He goes, give me my higher high. You don't give me my higher high, I'm closing. Going short. That's it. And that's why it's important to know, it's important to understand this trend. If you're going to trade the hourly chart, you pull that thing back, and you give yourself a couple months of data. You want to know what the hell you're looking at. You don't want to be so zoomed in that you're only looking at, the last 2 days of trading. There's no way you would know that you were in this. You haven't even made the uptrend yet. You got your low, your higher high, your higher low. You haven't made your next higher high yet. You haven't completed an ABCD. You know what I mean? So you don't even have, you're not even in an uptrend. You're close. You want to be. Some might call it an uptrend because you got one pullback. But, you know, you haven't made the higher high yet. You know what I mean? So, like, this is chop. Right? Still, with this being your last higher high, you're still in a downtrend. Look at this. Here's your high. Here's your low. Here's your pullback. You know? So other traders, depending on what the time frame they're looking at, they see this. They see bang. They see their low. They see their pullback. All that over there is noise. They're looking for a lower low. I guarantee you this is on someone's chart right now. This is what they're looking at. They're looking at a lower low. I'm looking at a higher high. Right? So it's all in context of what you're trading. You know, if we pull up a 5-minute chart, it's going to look very different. This move down here on a 5-minute chart is going to look catastrophic. You know, it's nothing. And at the end of the day, it's a higher high. you know, but it looks very different, super zoomed in. But if you're going to trade 5-minute candles, you put on a 5-minute chart. You're going to trade 4 hour, you put on a 4-hour chart. Just give yourself enough data so that you see the trend. You know, you need to see the trend. So, like, if I was trading on a daily, I'd give myself a year of data. You know, I come down here to the year button, bang. And this is what I'm looking at. When people trade oil or gold, you know, SPY, S&P 500, they're looking at, you know, a year to 5 years of data, because that's what tells them what they're in. You know, even with all that move right there, what we were just talking about, downtrend is the right move. You're in a clear downtrend. Nothing about this is an uptrend. This is all a downtrend. You know, and there's nothing stopping you from coming to a larger time frame and doing this. Because this line is going to come into play on your 1-hour chart. And look at the impulse, right? You got your high, you got your low, you got your pullback. Your next move down is this low. A, B, C, D. Inside of that, you have your A, B, C, D, A, B, C, D. You know, you got them all over to all these little impulses. But you're looking at the much larger picture based off of the time frame that you're trading. So you're trading daily. You know, I want to see a year of information. I want to know where this trend is headed. I want to know what I'm looking at. Am I trading in a channel? Am I trading in a massive symmetrical triangle? Is this whole thing a falling wedge? You know, that'll make a determination. That might change my bias when I zoom in and say, okay, here I am, and I'm looking for my higher highs, but, oh, you know, after all this time and all this trading, I'm coming up to a significant trend line. A significant daily trend line scaling back almost a year. I would say that this is pretty significant. And if we were to trade over it and get a retest on it and flip it from resistance to support, well, I'm looking to go long. And that's also price action. You know, that's price action trading. You're taking into account what the chart is telling you, what the chart is giving you. And if that's what the chart's giving you, then you take it. So even though we're back here... And
Brenna Sparks says TA is nonsense, or astrology.
Yeah, you know, I mean, you know, always you'll have people on both sides of the camp, but some people say it's self-fulfilled prophecy. Some people say it's, you know, it's a tool for manipulation. Yeah,
whatever helps. Whatever helps you trade, right? And make money.
That's it. I don't care if you flip a coin every time you make a trade. I think that's a horrible way to trade, but you know what? You might be right half the time. You might be right more than half the time. Based off of how well you flip that coin, you might be right 75% of the time. But that's not a consistent way to trade. in anybody's mindset. I don't care how crazy you are. But yeah, there's people that are adamant that TA just simply doesn't work, and that's fine. Those are people. It's not worth your time. It's not worth your effort. It's not worth your energy to even reboot or rebut that or engage in that conversation. Just okay, that's fine. I'm just gonna do my thing because I would rather be spending that time learning something than than to talk to a wall for someone who's already made up their opinion and said, that there's no way around it. That's fine. That's fine. You think what you want to think. I'm going to continue to draw my little lines over here, and I'm going to play off of them because I like my little patterns. they tend to work. And different markets are different. So crypto's still new trading wise. This particular coin ETH only has a year or so of data on it, 2 years of data. So it's not like you're
I've
trading
noticed
gold.
that I've had an easier time trading or charting Forex than I have any kind of crypto.
Forex is very, very, very different. Um, Forex, most indicators don't even work on Forex. Forex is a very, very, very different market with very few big players. You basically have 5 major banks that run Forex, at least on the major pairs, on all the majors. Exotics are, you never know what the hell you're going to get with exotics. But like Deutsche Bank, Chase Bank, Wells Fargo, like these banks run Forex.
Right.
There's no market without them. So it's very easy for them to see pending orders. And if 80% pending are going long, they can push it any way they want. And if they want to go short with it and lick 80% of the people, they will. If they want to throw you a bone and let 80% get a small victory to keep them in the game, they will. If they want to short it, lick them all, and then go long after everyone's licked, they will. so Forex is very interesting because a lot of indicators don't necessarily work the way you would think they would work.
See, and that's weird because it's a lot easier for me to chart. Like I've been paper trading USD CAD, and I've been doing good. Like I don't know.
Whatever you're doing, you keep doing it. Whatever you're doing, you
But
keep doing it.
what I'm doing with that doesn't work with crypto. Like it doesn't even translate. Like I'm literally just doing like support resistance and like channels,
Okay.
and it's working for me, but like on crypto that does not work for me.
Yeah. See, that's funny because Forex, you would think the way Forex is traded, you would think that would work less. But if it's working, you just keep doing it.
Right.
Whatever's working, you just don't stop doing whatever it is that's working. You just keep doing that, and you'll be fine. Keep in mind, every pair is different from the other pair. So if you're USD CAD, spend a week to 2 weeks trading USD CAD, and you'll notice cycles that tend to repeat themselves with that. I would stay away from exotics in the beginning of Forex purely based off of liquidity. Any major pairs are highly manipulated, but you could be on the right side. You want to be that little fish that attaches itself to the shark. You know what I mean? You just scoop up some of the remains from the big boys, and you can consistently make money doing that. But again, it's very much like this. You're not taking tops. You're not selling the top, and you're not buying the bottom. But you're very happy inside that 80% trading body, and you can live off that. That's fine. There's nothing wrong with that. So if that works, you do that, and I would continue to do that. Now, why doesn't it translate to crypto? Crypto is just a different market with different traders. See, in Forex or traditionals, futures, stocks, NYSE, a majority of the people trading, even if they're trading for retail traders are brokers or professional traders. That's what they do every day. In crypto, my belief is it's the opposite. You have more retail trading than you do anybody of a significant background in trading as far as what they do for a living is trading. So
Right. That's kind of how I feel about it. Like there's so many people using so many different strategies and stuff that it's just unpredictable.
yeah, I mean, put it this way: you have 1,000 people that are professional traders, and you give them a token to trade, and they're all going to be looking at probably similar things as far as support resistance or whatever their strategies are telling them, but it's all probably going to be very similar. Then you give 1,000 people $1,000 and just say go for it, and you have no clue what the hell you're doing. Well, that's when you have buying at 20K. You know what I mean? And no one's sitting there telling that dude not to buy when everybody went short. So you have people doing everything where you got levels that are there, reversal levels that are there that don't even make sense. You know, like this doesn't even make sense. This is in between, like, you know, the 5 and the 6 to an 8, like perfectly right in between the two. It's not even a level. It's not even a historical level. It's not a daily level. It's nothing. It's just like it just reversed for no reason. And that's because you have people that don't know how to trade trading. And that's cool because you're going to see a bunch of stuff that you've never seen before, right? But you know, you may develop some bad habits where like you're gonna win on a trade you weren't supposed to win on, and you'll get overconfident on that trade when you shouldn't have. And that's terrible because that'll come to burn you later. You know what I mean? Like you should have lost that trade. You won. You like
Right.
as long as you're disciplined enough to say like, okay, that's that's one for the Gipper. Then that's cool. But if you base strategies off of that, you're gonna realize you're gonna fail more than you're gonna win because that it should have never happened in the first place. There should have never been a buyer on the other side of that order. And that's what people that have been trading for 10 years, 15 years, 20 years, they would say there's no way anybody would ever bought that. Nobody would have ever bought that. Nobody would ever bought that. And then people buy it. And you're like, well, what the hell are these people doing? Say, all right, just take the win. You know what I mean? You need to get out of the trade, and you got out of the trade, but you shouldn't have. And that's where, like, they had I forget which one it was, but a currency a few years back, I mean, just tanked. It went, from 100 to 0 in overnight. And, I mean, it licked people out of their life savings. But it was one of those situations where everybody wanted to get out and nobody could get out because there was nobody on the other side willing to buy. Everybody's trying to sell, and there's not one dude willing to buy because everybody was an institutional trader. Everybody knew that they were trying to get the hell out. There's nobody on the other side saying, yeah, I'll take it. I'll give it a shot. And everybody knew this thing was over. It was done. You ride it into the dirt. And that's what happened.
Yeah, I've heard a couple of those stories.
Yeah, it's tough because that's, you set your stop losses up and everything. But, the way trading works is, if you're going to sell, you need a buyer. You're going to buy, you need a seller. And if you don't have it, you hold on to it. And there's nothing you can do about it. And that's the scariest part about markets when it comes to crashes and tanks is if everybody has the same idea and everybody's trying to sell, you're beat because nobody's buying.
You might be the one that's screwed.
Exactly, and you don't know when you got in that order book, but some of these big guys got orders played out for weeks, and bot traders have bots set up, right next to the server. So it's, they're going to get their orders in no problem. And even they might have trouble. If they have trouble, then you're screwed. You're never getting your order in. So then you're totally beat. So it's just, that's just something to be a little bit mindful of, when you're trading. So exotics are tough because of liquidity. The majors are okay, but you just have to be a little bit weary. If everybody's going long, you might be wanting to see how that short looks. If everyone's going short, you might want to be scoping out the longs. But I will say this, for a Forex, patterns tend to play out well. So head and shoulders patterns tend to play out pretty well. Inverse head and shoulders, falling wedges, symmetrical triangles, double tops, double bottoms, Gartleys, ciphers, bats, crabs, butterflies. They all seem to play out pretty well, which is surprising for that market because they could sort of take it any direction they want, but to play those patterns out could take from a few days to a year. I just saw a head and shoulders play out on Twitter that took 11 months. So when they do pan out, they pan out usually fairly well. So if you can recognize them, you can get in a little bit early, or at least you can get in with a more confident trade with a proper stop.
All right.
Yeah.
Cool. I'll go ahead and I'll work on this for this week, and then maybe in like the next week or two we can look at volume.
Yeah, so we'll do volume next week unless that doesn't work for you. But if it does, then yeah, we'll go over volume-based trading, pros, cons, where it falls in line, that type of thing.
All right. Thank you very much.
You're welcome. All right. Well, if you have any questions throughout the week, you know where to find me. Just hit me up. We'll take care of them. And then good luck. Practice.
I will. Thank you.
All right. You got it. Later.
Bye.